Hello, everyone. I'm Jeff Higley, president of the BHN Group. Welcome to the virtual edition of the ALIS Summer Update, New York edition. We appreciate you taking the time today to join us. We've got a great lineup of speakers and insights coming ahead. As you know, these are strained times for all of us, to say the least. I hope you are all staying safe and healthy. The hotel industry is going through unprecedented difficulty, and there are certain to be more bumps ahead as the world grapples with the effects of COVID-19. Again, thanks to each of you for taking time to be with us today. We held out hope that we would be able to have this event live in person at the TWA Hotel at JFK Airport until about 2 weeks ago. The surges in COVID cases around the country and the required quarantines for some travelers led us to make the decision to take the ALIS Summer Update series online. While we most definitely miss the camaraderie of seeing everyone in person, we're happy to present an insightful program that promises to keep you up to speed on the latest trends in the hotel industry. Before we get started, I'd like to take this opportunity to thank the entire team at the BHN Group, Jonathan Zink, David Seibert, Rachel Ugai, Tricia Gregg, and Razy Simons for their flexibility and hard work in keeping the program on track and making this happen. So, keeping it on track. And speaking of that, let's go, Razy, let's go to the next slide, please. As you can see, we're getting ready to celebrate the 20th annual anniversary of ALIS in January. We're looking forward to hopefully having a live in-person event with all of you there. Hopefully the virus is under control by then. Travel is safe, and we're working for a program we're working on the program to get started. Sponsorships are available right now, and registration is scheduled to open in early August. So please be aware of that and keep an eye out for that as we plan for our 20th anniversary. You can next slide, Razy. As I mentioned, this summer ALIS Summer Update series was scheduled to be live, and these 3 hotels were scheduled right up until about 2 weeks ago. The host hotels here, you can see the TWA Hotel in New York, Margaritaville, Nashville, and Virgin Hotels Dallas. We want to thank each and every one of them for their flexibility and willingness to work with us right up to the end when we had to make the decision to go virtual. So great staffs at these hotels, great hotels, and we're looking forward to working with them in the future for sure. So let's next slide. ALIS Summer Update, as you can see today on the left, Monday, July 13th, that's where you're at now. So hopefully you are where you plan to be. On Thursday of this week, we'll have a program in Nashville, a little bit of a shorter program, but still nonetheless very insightful and informational. And then of course, 1 week from today, we'll have another longer program in Dallas, which was our original Dallas program, online virtual here as well. You can still register for any of the other 2 events after today by visiting alissummer.com. Next slide, Razy. We want to make sure we thank our sponsors. We thank them very much. They've stuck with us through thick and thin here and through all of the moving parts. You can see all of them on the screen: AHOA, Davidson, MCR, Virgin, Access Point, Hall Structured Finance, Hodges Ward Elliott, McNeil Hotel Company, Stonehill, and Wyndham. Thank you. We just greatly appreciate your support throughout this most troubling time. So let's move on to the next slide. I'm going to introduce Jonathan Zink, the Managing Director of the BHN Group, to take us through the first series of programming for us. Jonathan, take it away.
Thank you, Jeff, and good afternoon, everyone. Welcome to all of you watching from your office, from your home, or potentially even relaxing on the beach and watching this great webcast. I gotta say, I'm a bit jealous if you're the one sitting on the beach, but we're excited. We have a great webcast planned, and most importantly, echoing Jeff's sentiment just before I touch on the agenda, is that very best wishes to you, your teams, and your families during these challenging times. I speak for myself, but the entire BHN team. We sure miss seeing you in person and networking with you, and hopefully we'll be back to that name of the game soon. As we dive into the agenda today, our webcast is focused on hotel capital markets. Many of our speakers are from the New York area. Development outlook, and of course, kicking us off before those presentations is an update from HLA. After the investment insights, we go into 3 different panels: investment insights, transformational projects in IREFAC, and then we close out at the very end. So it's my pleasure to introduce our first presenter, who really doesn't need an introduction. He's the president and CEO of HLA, formerly the head of HOA, Asian American Hotel Owners Association, and has a variety of vast array of experience. And one of the things I like to share sometimes is a fun fact about our speakers, because everyone knows the true bio and professional side of things, but Chip Rogers has so many fun facts, from root beer floats to radio talk show host to a variety of different ones. But one thing that I think is very timely is he's a diehard DC Defenders fan. And if you're not familiar with the XFL, it started in 2001, came back this year in 2020. So hopefully a fun fact for you. Ladies and gentlemen, it's a pleasure to turn the virtual microphone over to the president and CEO of HLA, Mr. Chip Rogers.
Yeah, Jonathan, that's a good fun fact. Not many people know that. And the real reason why I'm such a Defenders fan, other than just the great football that was the XFL, is that with Washington changing their team name, I've already got this Defenders swag. And I knew you were going to say that at Warner today. But now that swag can actually mean something if the Redskins become the Defenders. So that's my vote. Fastest 5 minutes in advocacy, if we can go to the first slide. Going back to February, the thing that HLA has been really tasked with is doing our part to help save an industry. And that's really the way we look at it. You see in front of you a list of items that we have been working on nonstop every day, of course, facing the same financial difficulties that everybody in this industry is facing. But pressing forward, making sure that our industry is defended and promoted, because that's what our church is. I'm going to go through these really quick because I only have a few minutes. Limited liability language, we believe the hotel industry will not be sued out of existence. So as hotels increase their volume, increase business, the last thing we want is the industry springing up from travelers who want to sue hotels or coronavirus. The good news is, as of the end of this week, we should have 9 states that have already adopted this language. We're pushing hard with the U.S. Senate to make sure this is part of the next package of legislation so that we protect our industry from frivolous lawsuits. Pandemic risk insurance, business interruption insurance, very similar to what we already see with terrorism risk insurance. This model has been tried through. It works. We're pushing on those 2 fronts. CDS, a lot of people watching me now understand what that means, also understand how difficult it is. This is an issue we've been working on now for about 3 months. We expect legislation to be introduced very soon. There's been a lot of activity on this on Capitol Hill lately. It took us at least 2 months to try to explain what this means to most lawmakers. That in and of itself is a challenge. Now on the verge of seeing some legislation that's critically important. Tax incentive measures, you've probably seen these in the news, all the way up to $80,000 to get individuals to travel with their families. These are not just business incentives, but also individual incentives. It's critically important. PPP, we were there from the very beginning, making sure that the, and I apologize about my audio. I'm going to turn off my video just so maybe the audio will work better. We were there from the very beginning on PPP, making sure that the affiliation rules waived so all hotels could apply for this. We were there when corrections came out, including the extension, and we're there again working on legislation. The one bill I would point out is the Restart Act. That's the #1 model in Congress, and it is, I think some, I apologize about my, I don't hear me. If you want, I can understand. The safe state guidelines are critically important. This is our effort to unify the entire industry behind a simple set of standards that make sure that we are conveying that message, not just to employees and guests, but also to policymakers about how important it is that our industry was the first out of the gate and has this uniform set of guidelines to make sure that our hotels are safe and clean across the board. And this is critically important in the world of advocacy. We are fighting, how can I say this, incredible pressure from organized labor to pass ordinances that would put an enormous financial difficulty on every hotel in that particular jurisdiction. San Francisco is probably the worst case example right now, but there are another 10 to 12 cities that are considering this. And by having Safe Stay and having everyone endorse that and be part of that, it is a critical tool in helping to prevent these just horrendous ordinances, which would cost millions and millions of dollars at each city level and probably hundreds of millions across the country if enacted. Last slide. So here's where we've been since day one. If you go all the way back to February, you see the first couple of packages, which got little notoriety, but that we were actively involved with. The third one is the most important one, and that is the CARES Act that included the original PPP. And just a reminder on how difficult this is. If you remember back at this package, which happened to be the largest spending package in the history of the world. No other country has ever passed anything this large, and they did it in about 2.5 weeks. At that time, what Congress was looking at was an 8 to 10 week period. If you recall, we as a nation were really arguing about this notion of whether we could open up by Easter. That was the discussion back then. So the PPP was originally intended for about 8 to 10 weeks. Luckily, we've had that expanded. We've had it refunded once. There's still a little bit of money there, but that was huge back at package 3. Package 3.5 was the Flexibility Act. The next package 3.5 was the extension of the PPP for the most part until the end of the year, and that was critical. And then package 4 is what we're working on now. And just to give you an update on that, they will, if they're going to pass something, do this by the end of July. So the next 3 weeks, the engagement that we need from our industry is absolutely critical. If you know of anyone that's in elected office at the federal level, if you could get yourself, your staff, and everybody involved to contact your elected officials, go through AHLA with our Hotels Act program. It's free. We can help you with that. But what we do in the next 3 weeks will make an enormous difference on how our industry performs over the next 3 to 5 years. Because the next package will, if it's going to happen, it's going to happen between now and the first part of August. So we desperately need your help. Go to AHLA.com, Center for Hotels Act, and we'll get you plugged in. But I want to thank Jeff and the team and Jonathan and everybody. This is an incredible organization at BHN, and I'm just honored to be able to represent our industry. And please feel free to call on us if we can help you at all. I apologize about the early difficulties on the audio, but Jonathan, I'll turn it back over to you.
Thank you, Chip. And we appreciate all the great work that you guys are doing as our voice for the industry. Thank you so much. I know there was some technical difficulty on the first slide, but we'll be glad to update you guys, everyone involved, going forward. So no worries there. And again, we person leading the charge for us and Chip Rogers. Thanks again, Chip. Now moving on to our next presenter, Hotel Performance Outlook. Hannah Smith is Senior Consultant, Head of in the Consulting and Analytics Division of STR. If you're not familiar with STR, you should be. STR is the numbers guru in the industry. And just continuing on the fun fact thing, Hannah Smith, one of her fun facts on her bucket list is to visit every U.S. national park around the country. And I'd just like to say the hoteliers are on this call or on this webcast, she might be coming to visit you very soon. Ladies and gentlemen, the virtual microphone is being turned over to Hannah Smith. Hannah, it's all yours.
Thank you, Jonathan, and thank you all for having me. It's a pleasure to be with you on this webcast. Now I'm going to dive right into the data. So on the next slide, we're going to start by taking a look at what the industry's gone through in the last 3 months in particular, dive into some of the unique dynamics we've seen at the class level and for the top 25 markets, and then finish up with our forecast. So looking at what the industry's seen the past 3 months, looking from March to May of 2020, demand has more than cut in half for the industry as a whole, ADR cut by 30%. You know, the past 3 months, this is the worst period that we've ever seen for the industry. We've never even seen a monthly occupancy of this number, much less a trailing 3-month occupancy of this number. So really unprecedented. And if we take a look at the next slide, you can see even further how unprecedented this is. You can see those declines in previous downturns in the early 2000s, and then in 2008, 2009. Those used to seem like incredibly extreme declines, but in terms of monthly RevPAR declines, we saw 80% in April of this year. We do believe that that's going to be the trough for the industry for this crisis, but of course, everything's always changing. We saw a little bit of improvement in May, down 71%. With the preliminary June data, we're expecting that to be, again, a slight improvement coming in between that 60 and 70% range. And when we jump to the next slide, we can take a look at that on a weekly demand basis. So that's going to be those yellow bars there. And again, you can see hit the bottom of the period for the industry, the week ending April 11th. It's been improving ever since, but we actually saw a reversal of that with the week ending July 4th. We saw demand actually retract a little bit. This came, everyone was projecting a big week for the industry. You had the July 4th holiday, and in particular, it fell on a Saturday this year, which usually means strong things for the industry. But we saw this come right as some areas, particularly when you look at Texas beach areas or Florida, these areas started to roll back their opening plans. So they started to reclose bars and beaches, and that caused then a rollback of occupancy in a lot of those markets. The other thing that we can see on this slide is the relationship between the TSA checkpoint counts and room demand. Now, this isn't a perfect relationship, and we're certainly not saying that, 60% of all demand used to come from, flyers through these TSA checkpoints, because we know that people flying don't always stay in hotels, et cetera. But it used to be a fairly consistent relationship, and we've seen that relationship really collapse during this crisis. So now those TSA checkpoint counts only account for 27% of hotel demand, meaning that that demand is coming from other sources, whether that is local healthcare workers or other recovery-related demand. And then in recent weeks, some of that recovery of the leisure drive-to demand. So now on the next slide, we're going to take a look at some of the shifts that we've seen between classes. And overall, the story here is that we've seen kind of a trickle-down effect where the demand is going to lower and lower classes. And so economy is now representing about 40% of all demand in the US. Of course, this doesn't mean that people that used to stay at luxury hotels are now staying at economy properties, but rather that trickle-down effect where now economy is representing a greater share of that demand. Upper upscale and luxury, it's unsurprising that this segment has been hurt the most. This is also the segment where we've seen a lot of the closures happen in April and May, but obviously they're really hit hard by the loss of groups, the loss of business travel, et cetera. And on the next slide, we can take a look at how not just demand, but also ADR has been affected in their dynamics between the classes. You see luxury dropping over $100 year over year. And so that decline, particularly on the high end of the spectrum, has caused kind of a compression between the classes. So in 2019, there was about a $120 difference between economy and upper upscale. Now in 2020, that same $120 difference will actually get you from economy to luxury class. So that's just illustrative of that compaction of the ADR premiums. So now in the next slide, we're going to shift our focus to the top 25 markets. Overall, the top 25 markets have really been hit harder than the total US, whether that's the loss of the convention and group business, business travel, or whether people are just trying to avoid congested city areas right now. So this is looking at just supply closures as of the full month of May. Down there at the bottom, we actually have two markets that closed more than 50% of their supply, Miami and perhaps unsurprisingly, Oahu. Obviously, they rely on a lot of that flight traffic that they're just not able to get right now. And on the next slide, you can see how that's reflected in the demand data as well. Remember, when we were talking about the total US over this trailing 3-month period, there was a decline of 55%. Those top 25 markets have seen an even stronger decline. You see some of those markets down there at the bottom. I've called out some of the Northeast specific markets, Philadelphia, New York, and then Boston down there in the bottom 5. seeing a greater than 70% decline. So much stronger than what we're seeing for the total US as a whole. And then on the next slide, looking at the ADR dynamics, you can see then that, interestingly, some of those markets that were losing the most demand are actually losing the least ADR. So when you look at markets like Oahu, Miami, Orlando, which were at the bottom of that demand chart, they're actually faring a little better in terms of holding on to their ADR. When you look at the bottom end of the spectrum, though, what we're seeing is those kind of higher priced, more premium markets in normal times are certainly suffering more great ADR losses in this period. You have New York, San Francisco, Boston, Chicago, all down there losing over 40% of ADR. And now jumping ahead to the next slide, this is our total US forecast as of June. So looking at RevPAR declines of 50%, that's coming mainly from the loss of occupancy, certainly a little bit of rebound next year, but I think it's more valuable to look at this in terms of absolute performance instead of those percent changes. So on the next slide, we can see what that looks like. And that 2021 performance is still projected to be 30% lower than 2019 performance in terms of RevPAR. So although we are expecting a little bit recovery, it is going to be a long road ahead, with demand projected to recover by 2023 to 2019 levels, ADR much slower to recover, as we're expecting pricing power to be a little bit more difficult to find, especially as you're competing for that lower demand. So on the next slide, you can see that same dynamic at the class level. And I'm going to breeze through these pretty quickly, but it's really the same story that we've already talked about at the class level, which is those lower classes aren't suffering as much. The higher classes, upper upscale and luxury, those are going to see kind of the greatest declines, in particular when it comes to occupancy. And you can take a look at that on the next slide as well in terms of that absolute performance. We are projecting most classes to reach above a 50% occupancy next year, but that's still just well below what we've come to expect from the industry, given that 2019 was a record-setting year for performance for the industry. And then my last slide here is just taking a look again at that demand recovery and what that means in relation to 2019 levels. So those higher classes representing about 80% of the demand of 2019 levels. When we get to the lower classes, it'll represent, 85 to 90% of 2019 demand. And that's more representative of the smaller decline that they're going to see this year rather than a faster recovery. So thank you very much, and I'll turn it back over to Jonathan.
Perfect. Thank you, Hannah, very much. And we're delighted to have the Hotel Performance Outlook kicking us off. And now kind of moving on into our next presenter, Hilda Perez Alvarado is CEO, the Americas for JLL Hotels and Hospitality. And I'd also like to extend a congratulations to Hilda, her 5-month-old daughter, baby Hilda Marie. Congratulations. Hilda, the virtual microphone is over to you.
Thank you very much, Jonathan, and pleasure to be here. So if we can go on to the next slide so we can kick things off. Next. Next, please. Okay, great. So in terms of what we're seeing globally, global transaction volume for the first half of the year right now is down 56% compared to 2019 levels. The largest decrease we've seen is in Q2, where transaction activity dropped by almost 80%. January was actually a pretty strong month, given that there were several transactions, large transactions that closed in the first 2 weeks of the year that should have closed in the year prior. The largest decrease in activity globally has been in North America, specifically in the United States, and that is followed by Asia and in Europe. In terms of what investors are doing, they are still keeping busy despite transaction volume being where it is. And several of them have actually shifted focus to focus on loan sales, rescue equity, rescue capital, and preferred equity structures. As it relates to pricing, I would say that pricing is still pretty complicated and pretty hard to pinpoint. So investors, for the most part, are going back to basics. They are looking at price per key, discount to replacement, and in several instances, specifically in New York City, we are looking at highest and best uses. and more on that in the coming slides. As it relates to lenders, we are seeing quite a bit of flexibility with the lending community across the world. Several of our investors are actually, they were expecting to see a little bit more distress in the system. However, in certain cases in the US, a lot of the lenders, especially balance sheet lenders, are very much willing to work with the borrowers. And in other places, such as in Europe, specifically Spain, we are seeing governments mandate moratoriums on repayment. The last 2 points, cross-border activity is still actually pretty active, and we are seeing global investors wanting to make a move into this space. Specifically, the top 3 markets that we get asked about all the time are New York City, Tokyo, and London, in that order. In terms of the last point of when we expect activity to come back, we do expect for the end of the 3rd quarter and beginning of the 4th quarter to actually see quite a bit of transaction activity as forbearance periods come to an end. The summer season's over for several resorts. Carry costs continue to amount, and government assistance programs come to an end. And this is not specifically a comment about the United States. This is a global comment. Next slide, please. As it relates to the demand side of the capital markets equation, we actually continue to track record level of capital sitting on the sidelines waiting to enter the space. In fact, since 2015, the amount of capital raised in closed-end private fund targeting hotels has grown by about 35% compounded. Now, a lot of these investors, as I mentioned on the prior slide, are focused on asset managing their existing hotels. All of our investor base has actually indicated a willingness to continue to invest in the space, but they're just waiting for more distress to happen and for prices to come down and for more product actually to become available. So the question is, with all this capital available on the sidelines, is, you know, the pressure of so much capital chasing few deals, is that going to result more in a soft landing versus the hard crash that everybody is anticipating? The last point I'll make on this slide is that it is very interesting to see and track the investor composition so far. So obviously we are having a lot of discussions in all the transactions that we're running with existing hotel investors, also new entrants into the space, specifically family office and high net worth. But really interestingly, we are seeing alternative investors, and most of these focus on the living sector. So anything that has to do with multifamily, senior living, and student housing, looking to make a play, acquiring hotels that are maybe big box, have quite a bit of functional obsolescence, and sit in many of the world's most polycentric cities where it makes sense to actually do a conversion of use. Next slide, please. From a capital outflow and inflow perspective or cross-border, whilst the crisis has impacted all of the investors worldwide, we do still continue to see quite a bit of capital coming out of the Middle East and specifically out of Qatar. The other group that we're tracking very closely is capital coming out of Europe into North America, specifically the United States. And of that, we're seeing definitely an uptick in activity out of UK investors, and this is both private equity and ultra high net worth. The net beneficiaries of this inbound of capital continues to be Europe first and foremost, and the United States in second place. Next, please. So in terms of what is happening in the United States, well, the US is leading the charge in terms of the decrease. So unfortunately, the second quarter of 2020 actually marked a 10-year low in investment volume, with volume declining 92% year on year. The first quarter of 2020 was still relatively robust given the number of deals that were closed in the first half of January. But again, all of these were actually overhang from 2019. Next, please. Great. So in terms of transaction activity, the first half in total marked a 68% decline in transaction activity compared to last year, with most of the drop coming from single asset sales. And as you can see from the investor profile perspective, the chart on the right-hand side, private equity continues to lead the charge by a very wide margin. So far this year, they've actually accounted for about 50% of all trades. That is followed by owner-operator, offshore investor, targeting mostly luxury. And under other, you're seeing an uptick in that figure, and that includes family office as well as the alternative investor that I was discussing in the prior slide. As it relates to REITs, they have been relatively muted. They've only accounted for about 2% of all transaction activity this year. Next slide, please. This is a pretty astonishing chart, actually. So out of all the transactions that have closed in 2020, which amount to 88 trades, only 8 actually took place in the second quarter of this year. So moving on to the next slide to talk about lending. Really, the name of the game here is flexibility. So lending right now is actually focused on bridging the gap until the demand recovers and hotels open up again. And not wanting to go into immediate foreclosures. A lot of these lenders are working hand in hand with their borrowers, and we're seeing the most flexibility happen in the balance sheet space and balance sheet loans. We'll talk about CMBS on the next slide. Now, as it relates to new financing, sorry, Jonathan, just go back to the prior slide. As it relates to new financing, we're seeing very little activity around construction financing for the obvious reasons. And in terms of new acquisition financing, most of our investors right now are underwriting, assuming all equity, and they are planning to put financing on the assets probably a year to 2 years into their purchase. In some instances, we are seeing existing lenders rolling in their loan at modified terms. So let's go on to the next slide on the CMBS market. So this is where we're seeing the most pain right now. Specifically on lodging, the sector has the highest delinquency rate at 23%, or the equivalent of $16 billion of loans spread over 744 hotels. This is as of a week ago. That number could have come up. This level surpasses any other level of any other prior recession, and we believe will be the source of trades later on in the year. So the next slide. This is the final slide of the presentation, but if you dissect the data of the CMBS loan, this is actually quite interesting. You look at the top 5 markets that have loans in special servicing, they account for about 30% of all delinquency that we're seeing in the United States. The other fact that catches my attention is that out of the top 5 markets that are leading the charge on special servicing, 4 out of the 5 are part of the 10 most liquid markets in the United States. So we are having quite a bit of investors spend time in this space, trying to see when they can go out, when they can acquire some of these loans. If you pay attention also to New York and Miami, out of all the CMBS loans that have been issued in New York and Miami, 41 and 46% of those loans respectively are in special servicing. That's it from our end, Jonathan. Thank you.
Thank you, Hilda. Very much appreciated. And we've moved from hotel performance to transactions, and now we're going to move on to development outlook. Our presenter, JP Ford, SVP, Director of Global Business Development, Lodging Econometrics, over 30 years of experience, business development, disposition, and acquisition services. Ladies and gentlemen, virtual microphone over to JP Ford.
Thank you, Jonathan. Can you hear me?
Yes,
Jonathan?
JP.
Okay, terrific. All right. First of all, thank you very much, Jonathan. I want to thank the BHM team, Jeff Higley, and it's great to take part in another ALIS Summer Series program. So thank you for having me. And if you'd be kind enough to advance to the next slide. All right, terrific. This is the U.S. construction pipeline by projects and by rooms. And what you can see here is down the lower left, across the bottom, excuse me, you have year ends 2013 all the way to 2019. And then you can see where we are at the end of May of 2020. So the construction pipeline in terms of number of projects stands at 5,693, 701,000 rooms. So you think about COVID, you think about everything that happened early, mid-March is when it started. We have lost out of the pipeline 55 projects in about 8,000 rooms. That may come as a little bit of surprise to some. Some may have thought it was a little heavier than that, but that is in fact where we stand at the end of May. That'll change obviously at the end of June, and we'll have our second quarter update probably within the next 10 days. But the construction stages, I'm sure you're all familiar with them. What's under construction, start in the next 12 months in early planning. And you can see in the early planning stage, it's somewhat reduced versus the year-end close of 2019. So I got a lot of slides to move through, so I'm going to go kind of quickly here. Thank you. This is the forecast for new hotel openings, reforecasted as at the end of May. And for the first 5 months of 2020, we opened 26,186 rooms, and are forecasting an additional 76,503 rooms from June to December, which will give us about 102,690 rooms, which will represent a growth rate of 1.9%. Now you can remember that when we were in the middle of COVID here, you had some states that halted construction, you had some cities and markets that halted construction. That all came back in June. So everyone is back on the job, and those construction crews are working to finish up those projects. And so we are at 102,689 for year-end 2020. Jonathan, next slide, thank you. And just to break down the construction pipeline by project stage, as of May, 1,850 projects in the pipeline, which is actually up over Q4 2019. Start in the next 12 months, projects in the pipeline are up as well. And in the early planning, that's where we're seeing most of the drop right now. So in those three stages for the pipeline, you have the comparison from Q4 19 as of and compared to May 31, 2020. Next slide, please. This is a breakdown of the construction pipeline by branded and unbranded and by project stage. It's a little different than the previous slide, but many people in the industry like to see what's branded in the pipeline, what's unbranded in the pipeline by way of projects and rooms. And this also gives you a rather timely comparison from Q4 2019 to May 31, 2020. And you can see the various stages down the vertical legend of this slide. And you can see the big drop off in the early planning that we talked about just a few moments ago. Next slide, Jonathan. Okay, this is the construction pipeline by chain scale. This is a slide that we produce all the time. And there really is no difference in this slide as compared to how this slide may have looked at the end of 2019. Throughout this lodging development cycle that we've been in, we've all known that the big pipeline or the big chain scales stages have been upscale and upper mid-scale. Those two chain scales have really dominated the development in this lodging real estate cycle that we're in. Same is true today. A lot of those types of brands you're familiar with that are fit into those chain scales. You can see towards the bottom as well, there are 626 projects in the pipeline right now that are unbranded. We estimate that 85 to probably 90% of those 626 projects will ultimately select a brand as they move forward. Next slide, Jonathan. Okay, I'm going to take a look at a couple of markets here, top markets by rooms with the forecast. As of May 31, you had Los Angeles with 167 projects in the pipeline. Again, in different stages, some under construction, some going to start in the next 12 months, and some in early planning. And you can see how that compares to Q4 2019 for Los Angeles, New York, and the remaining three markets there. There's also towards the right on this slide a June to December 2020 forecast for new hotel openings for each of these markets as well. And you can see the corresponding number of projects and the number of rooms that we estimate will open between June 1 and December 31, 2020. Next slide, Jonathan. Okay. Construction pipeline by region. What we've done is we've broken up the country into 9 different regions here. And you can see that most of the development in the country is happening in the South Atlantic region. With 1,355 projects, almost 171,000 rooms. That represents 24% of the pipeline. Again, this really hasn't changed since the end of the year 2019. It's relatively consistent. But as you think about different markets, as you think about different regions of the country, and as you think about different regions of the country that have seen recent spikes, this gives you a nice overlay. Next slide, Jonathan. Okay. Here's the construction pipeline by select franchise companies. Marriott and Hilton have always been at the top throughout this development cycle. And you can see the number of rooms that are in each one of their pipeline. And this is new construction only. It does not account for any renovations or any conversions that they may be working on. And then you have IHG, Hyatt, and Best Western as well. So you have 491,000 rooms represented by these top 5 global franchise companies. Next slide, Jonathan. What we've done with this particular slide is broken it up into 3 different sectors here. This is the current supply, number of open and operating hotels. If you look at the first line, you can see Marriott has 5,102 open and operating hotels, almost 850,000 rooms. This is all just U.S. by way of reference here, and this is as of May 31, 2020. And then you can see their pipeline totals. And then across in the third box, you can see the new hotel opening forecast for each one of those companies from June to December. Okay, Jonathan. What I want to do here for the next 4 slides is, since this ALIS Summer Series event was to take place in New York, and obviously we're not there physically, I put together 4 of the top cities on the Northeast Corridor here and wanted to give you a little more granular information on New York. You have under construction 105 projects as of May, roughly in line with where it was at this time last year. And then you can see the other project stages in New York. So New York has essentially lost 7 projects, but actually gained a few more rooms in the pipeline in the past 5 months. Jonathan, next slide, please. So we just looked at New York. This is Boston. Boston slide is set up very similarly to the New York slide. Thank you, Jonathan. Philadelphia. Quick overview of Philadelphia right now. And then the next slide would be Washington. So you have a picture of the 4 major cities that represent the Northeast Corridor here, and how their construction pipeline looked as of Q4 2019 and as it looks as of May 31, 2020. Set for the next slide, Jonathan. Okay. Select market, new hotel openings. We have New York City, June to December 2020 forecast, 32 projects. And then we forecasted out for 2021 and 2022 as well for each one of those major markets. Okay, Jonathan. This is a slide that we had at the ALIS Summer Series in Boston last year. And I remember Jeff getting on stage, and we put this slide up. And these represent the new brand announcements since January of 2015. I just really wanted to bring this back to the forefront of everybody's thought here. And when we had this presentation last year in Boston, we had 95 new brands that had been announced since January 2015. And we did the new count for this ALIS Summer Series, and we've actually gained 11 new brands since that time period. Obviously, those announcements happened right before or at the end of 2019. I don't recall any new ones being announced since that time frame. But that's the state of the industry as it relates to new brand announcements. And I think that's the last slide. So, Jonathan, I want to say thank you. And that's it.
All right. So, well, thank you very much, JP. We also want to thank Hannah and Chip and Hilda for that presentation. Before we get into the next part of the program, I want to remind you of BHN, and we are a division of North Star Travel Group. You can see all of the brands that comprise North Star. Proud to be part of this big family of travel brands that they keep you posted on the entire travel industry. So with that said, let's move on to the next slide as we talk about, as we're going into the programming here, the investment insights, the deal makers. And as the speakers start coming up, just going to do a quick introduction. Mark Owens, the moderator, he's EVP and head of Hospitality Capital Markets for CBRE. He's going to have a great discussion with Kellen Florio, Managing Director and Global Head of Lodging and Leisure Investment Banking for Goldman Sachs, and Croft Young, Managing Director for Morgan Stanley. Mark, please take the floor, and eager to hear what you gentlemen have to say.
Terrific. Thank you, Jeff. Look forward to the conversation and appreciate the opportunity to be here with all of you and be a part of the ALIS Summer Update. And I'm happy to share the stage, the virtual stage, with Croft, as Jeff mentioned, Managing Director of Real Estate Gaming and Lodging Investment Banking at Morgan Stanley, as well as Kellen, Managing Director, Global Head of Hospitality and Leisure Investment Banking at Goldman Sachs. So with that, I'm going to turn the stage over to Croft and Kellen and ask them to introduce themselves to the audience, give a brief background about your role and what's been keeping you busy since the end of March. Croft, I'll turn it to you first.
Sure, thanks, Mark. I'm Croft Young. I'm a managing director at Morgan Stanley and part of the global investment banking platform. We provide execution advisory services around public and private capital markets transactions, mergers and acquisitions, and other strategic initiatives. I spend the bulk of my time in leisure and lodging, as well as the accommodation space. And I think, since generally we're working on all sorts of types of transactions, and that's continued to be the case since COVID set in. Obviously, there's been much more of a focus, and initially there was much more of a focus on sort of cash management of our clients, the ability to access capital and shore up liquidity, and kind of understanding the lay of the land as things played themselves out. Since there's some of that still going on, particularly I think in the private markets, and we can talk about that a little later, but we're now kind of starting to see, as things start to reopen, albeit with some hiccups, people are starting to kind of think forward and try to think about where opportunities might be from a more proactive and offensive perspective.
Great, thanks, Croft. And Kellen, how about you?
Sure, and thanks, Mark. So similar to Croft, I spend the bulk of my time in the hospitality and leisure space, heading up that coverage for us globally at Goldman Sachs. Been at the firm for about 15 years and seen the business through a number of cycles at this point. This one certainly is unique. As Croft said, I think a lot of similarities in kind of where we spend our time and what our clients have been focused on, but in our business, very much an advisory business as opposed to investors ourselves. So working with the publicly traded companies, private companies, financial sponsors, family offices, and individually owned businesses that kind of run the spectrum across lodging and leisure, from the asset heavy REITs and owner operators to more service oriented businesses that touch the fringes of travel. Very much a consistent theme over the past few months, which is what used to be or what had been very much a growth minded corporate strategy to shifting toward a very much liquidity and defensive minded strategy. Mostly, I'd say for most of our, especially publicly traded companies, have worked through a lot of that liquidity enhancing, transaction, and are now starting to think about what's next. No, I need to be defensive. No, I need to be cautious, and the future is still very much uncertain. But feel a little bit better about my financial footing, and also want to start thinking about how I can actually take advantage of what is clearly a dislocated market, where you might argue it's a buyer's market. So I think we've certainly evolved over the past few months, but still in a little bit of an in-between zone as you think about pivoting from the defense to the offense. Appreciate
that. Yeah, and similar sentiment here that we're seeing with our conversations with clients, sort of. But there is still, per Hannah's presentation, as well as Hilda's and JP's, there's still some pretty substantial challenges, I think, that we have ahead of us, particularly, a strain from a liquidity perspective across the industry. With so much of the inventory closed, and many groups speculate that a good portion of these properties may actually never reopen. as lodging product. What is the broader sentiment in the conversations that you're having, with your clients and investors, as you mentioned, forward-looking and dealing with the current issues that they're experiencing right now?
Well, I think that that broadly, as Kellen said, I think there's broadly a recognition, and as the other speakers have noted, there's a long slog back to 2019 RevPAR, if that's what you want to use as the benchmark. And so there's an appreciation that that's going to be a long process that people are going to have to get through. There's also an appreciation, though, that as Kellen also noted, there may be some dislocation yet to come, particularly in the private side, where there's been a few things that have kicked it down the road that potentially the public players may be able to take advantage of. But I do think one thing to note here, as far as how people are thinking about it, is there is we paint a broad brush because this happened to everyone so quickly, but there is a very different kind of place that different players in the space sit. If you're in an extended stay kind of platform and you're outside of the major markets, you may even be doing better than you were doing otherwise. Whereas if you're a New York City group-oriented convention hotel, you probably have the longest road ahead. And so drive to leisure versus international fly to group business is going to have a very different recovery. And so people are having to position themselves differently based on that.
And Kellen, any additional comments on that?
I mean, look, I think Croft covered what I would say. I think the only thing I would add is when we talk with our clients about how they think about the forward outlook for their businesses, I think there's still a high degree of variability in terms of scenario planning that our clients are using on. And again, from our standpoint, it tends to be more on capital cushion and liquidity reserves, as well as, and then how does that kind of parlay into the ability to be a user of capital for growth purposes or investment purposes on a non-essential basis. And I'd say the range of scenarios that our clients are still focused on are still very broad, and still very much in a cautious standpoint in terms of what's going to govern the allocation of capital toward growth.
And Croft, you mentioned sort of the differing performance metrics of, let's say, full service urban core versus extended stay. In your conversations with the investment community and those looking to place capital, what are you seeing from their seat? Are they looking to deploy? Are they still cautious? What is the overall sentiment, both domestically as well as globally, when looking at the various sectors?
Well, I think to sort of give you a non-answer, I think it's both. I mean, I think there's certainly caution around, as Kellen mentioned, there's still a ton of uncertainty around where this thing's going to go and how it's going to play out. But as Hilda mentioned, there's an inordinate amount of capital sitting on the sidelines that is, extremely concerned about missing out and not being part of the first part of the cycle. And I think that, one of the things driving the lack of transaction activity among a number of factors is that uncertainty that still remains, and people are just waiting for the moment that they can kind of feel comfortable enough to get in. And they're obviously looking at a wide variety of opportunities. As far as if your question was around which sectors are focused on, I think it just depends on the investor. I mean, I've even had people saying that they are interested in putting money into group, et cetera, because they don't think it's dead and they think there's a future there and a real buying opportunity.
And Kellen, how about you from investor sentiment, both domestically and globally, as to the various subsectors of hospitality?
Yeah, look, I think, interestingly, the U.S. business is, as far as listed companies and just the private market opportunities, is by far the deepest. And even the global businesses domiciled outside the U.S. have significant U.S. presences. Think about IHG and Accor and others on the branded side. So I think the U.S. market is still very much the barometer, and yet it still feels like it might be among the more conservative end of the spectrum when people think about the road to recovery. Just look, Europe is a very fragmented market as far as how individual countries will perform, and I think there's an expectation Germany should certainly outperform a country like Italy, for example. But when you think about Asia, again, a few steps ahead. And I think there's already capital that that I think that's willing to kind of get put to work, more offensively there than we'll see in the U.S. I think for a period of time. But I think the U.S. market is very much very much going to straddle this, going to straddle the offense versus defense for a long period of time here. And I think that because there's enough capital on the sidelines, all that capital will eventually find a home. And bid-ask spreads on transactions will certainly narrow. I think we're still in this phase where transactions are still meant to support liquidity, as opposed to be a change of control, especially at an asset level. We see a lot of owners of assets prefer to bring in capital to help them address liquidity needs for a short period of time, as opposed to walking away because they believe in a rebound and they believe that there's equity value there to to retain and capture down the road, potentially on a refinancing or an exit. And so still very much in that preservation mode. I think in the in the publicly listed space, we've seen a number of capital raises outside of the lodging world, in the deeply affected sectors that have an equity component to them, whether it be the travel services businesses and the OTAs, cruise companies, airline companies. We've seen a specific lack of issuance of equity among hospitality companies, whether it be REITs or operators. And I think the reason is simply that if you don't have to raise that equity today, why not play it forward a little bit to see when there's a better pricing available in the market. Probably not for lack of investor demand, but lack of corporates willing to kind of take dilution at these levels, at the corporate level, and prefer to kind of look down to the asset level for liquidity.
And I think that also, just to your last comment, Kellen, I think that speaks to the availability of capital kind of across the stack, because those public companies have been able to avoid having to go to the equity markets, largely because they have had strong access to the debt markets.
Well, and so to that point, Croft, I mean, with the the corporate credit issuance being so strong and credit lines being adjusted across the public hotel sector, balance sheets, it seems to be are in a better place. What are you thinking, or what is your view on what takes spurring of M&A activity? Let's talk about the public sector first. When do you start seeing transactions evolve, other than just in the debt space?
Well, first I would say let's talk about where people are positioned. And I think most of the public players, whether on the asset heavy or the asset light side, have found accessible capital markets, particularly on the debt side. They've found accommodative relationship lenders, and they've found ways to shore themselves up and put themselves on a path to make it through this. But that does not mean that they, are not, and part of that is due to the fact that they did go into this with good conservative leverage levels. But that does not mean that coming out the other side, they're not going to have pretty elevated leverage levels. And a lot of these companies have taken agreements with some of their lenders around covenant holidays, et cetera, that when those burn off in 4, 6, 8 quarters, may still be at highly elevated leverage levels, which may require at that point either equity offerings to delever the balance sheet, asset sale to delever the balance sheet, or potentially that could be a catalyst for M&A. But I think a couple of things that are going to be, to me, the biggest catalysts for M&A sort of across the board right now are largely bid-ask spreads that Kellen mentioned, and then the ability to access financing, particularly for the private side buyers.
Yeah, and I'll pick up from there. And you think about, we'll talk kind of corporate M&A for a minute, and we'll bifurcate between the REITs and the operators. When we look at the REIT space, right, there have been 3 large corporate M&A transactions in the past 3 years or 3.5 years, all of which ended up being a predominantly stock deals, so stock for stock mergers, some cash component. And frankly, the acquirers in those cases have been net underperformers of their peers in the subsequent period, for a variety of reasons. But point being, public investors in REITs that have been net acquirers through corporate M&A have been underwhelmed with their returns. So the bar is set pretty high as far as corporate M&A in the REIT space for stock deals. For take privates, there's always the natural question of, okay, prices are depressed, discounts to NAV are significantly low, shareholder bases have turned over, so shouldn't there be some receptivity to take privates, all cash at share prices that are not even approaching pre-COVID February levels? I think it's and there's certainly private equity capital, as Croft alluded to. There's been some debt financing available to folks in the relationship space, bank loan, term loans, and in some instances in the high yield market. Park Hotels accessed that market as a debut issuer a couple months ago. But for a take private to really pencil, I do think there needs to be more receptivity to debt financing in the CMBS markets. It's not 100% the reliant market. I think you can get creative in other structures, but that's really been the way in which financial sponsors have hit return targets in the past. So I think you'd like to see some more shoring up in that market. I think when you look beyond that, I think there's still a lot of uncertainty. I mean, despite the fact that there's a lot of private capital and prices are depressed, and there is a reason for that, and markets are relatively efficient. And so I think even financial sponsors that that maybe could justify underwriting attractive returns at these levels still have real questions as to the performance going forward, and that is that's going to be a big driver of of still focusing on a discounted value. I think for the brands and the C corps of the world, I think M&A is usually taking a step back from the current environment. M&A is usually growth oriented. Sometimes sometimes you see consolidation come out of an environment where there's no growth, and the only way to find growth is through M&A and synergies, whether it be revenue or cost synergies. We saw a lot of consolidation for example, in the gaming technology space a number of years ago, about 5-6 years ago, as a result of a lack of growth opportunities. I think we have a lack of growth opportunities in hospitality, but we don't have, on the brand side, at least in the larger global types, the IHGs, the Marriotts, the Wyndhams, and the Choices and the Hiltons of the world, we don't really have distress at those levels. We might have some distress at the smaller, more private businesses that have lack of access to capital. So you could see some consolidation from that standpoint, but you also have a lack of willingness to deploy capital from the larger growth companies. So I think we do have still a bit of a, not just a bid ask, but a structural dislocation to prevent some M&A at the corp, in the C corp world for a period of time. This can certainly all change in the next couple quarters, but we don't have all the the building blocks right now to kind of fuel M&A.
Well, and so just jumping back to one of the comments you made a few minutes ago on the debt side of the equation and a well-functioning CMBS market. The 74-unit Wood Springs Suites deal, it was originated pre-COVID. It just sold successfully into the bond market. Does that change your view? Is it a green shoot that people should look for, or is it purely just creating capacity for the originating bank to get it off their books and redeploy, or does it potentially fundamentally change the ability for one to look at a leveraged scenario for a buyout of some sort?
I think we're going to be a long way from sort of new origination, regular way CMBS until there's some sort of a stabilized, level of performance that people can sort of underwrite off of. We're currently there's still too much uncertainty. I know we're beating that horse to death, but I think it's totally true. And I think that the Wood Spring deal is definitely a positive. They got a deal done. But I don't know that you can read too much into that, given that it was originated prior to COVID. And also, I mean, again, it's an asset class that's actually, performing very well at the moment.
Yeah, and look, we weren't a lender. I don't think Morgan Stanley was on that either.
No.
I have to imagine that the lender, which I think was Citi in that case, look, we're in that business. Morgan Stanley's in that business of making loans and securitizing. You're in the moving business, not the storage business. At some point, you need to move it, and so they did. I'd imagine they took a material loss. I don't know the economics exactly, but look, it's positive that there was a buyer base for it. But I don't think there's going to be a whole lot of read through, and given the fact that you've got dislocated, trailing performance. It's going to be tough, for banks like us to be originating new loans for CMBS, for a period of time. I think you could see banks, start to warm up to balance sheet lending, for more protected asset classes like the Wood Springs, like the extended stay, type hotels of the world that have, weathered the storm a little bit better. But generally, I think it's a market that's, that's really focused on cash flow. And when I'd argue half the hotels in this country aren't cash flow positive right now, it's, it's tough to see there being a whole lot of, willingness for new loan origination, with a CMBS exit intention.
And from an investor standpoint, right, we've been speaking a lot about the institutional side. I mean, across the platforms, on, whether it's the retail or the, the private investment side and raising funds either through the private bank or other bank clients that are maybe not the C Corps or REITs. Has there been any changes in sentiment over the last, 3 months there, and willingness to explore, additional transaction activity in the hotel space?
Look, one area that I'd say that, look, from an interest in the hotel space that has certainly been different in the current environment is, look, you've got the obvious investor types in the public markets and the private markets that are, either real estate dedicated or active investors or holders of hospitality. But there's a much broader pool out there of generalists that are looking at the lodging world as a place that has two key elements that are interesting to people. One element is that it's, there's dislocated pricing. And so that always is going to kind of screen interesting. And then the second element that it has is that it has the expectation of mean reversion. We don't know exactly when that will be, if we'll hit these 2019 RevPAR and EBITDA levels until 2022 or 2025. But there is an expectation that this is not a secular impact to the hotel world, like you might argue that it could be in other impacted sectors, whether that be cruise or, or corporate travel services or other businesses. And so I think when you screen positive on both of those, I think that tends to attract, a bunch of different folks. And so we've certainly had much more dialogue, and again, focused on the private markets where I spend all my time, much more dialogue with some family offices and sponsors who may or may not have historically been invested in lodging, but are viewing it as a space that they shouldn't ignore. I don't think we've yet to really see private market dollars be put to work, from those types, given there's been limited deal activity and therefore opportunities. But a lot of these guys have looked to play the public markets and study them very closely in a way to get, prepared for the opportunity in the private markets, or to actually put capital into the public markets when there's been those opportunities.
And I think there were more traditional names, investor names, who historically have been hotel and lodging sector investors who actually were not playing in the last 12 to 24 months because they thought things were rich, overpriced, and there was a very tepid growth outlook as far as RevPAR, et cetera. So I think you do have a lot of investor interest across the board because a lot of those names are now back in because they see better pricing and a more attractive growth profile.
Great. And, thinking through just what is going to be required and how things evolve through this pandemic and just changes. I mean, are there ancillary concepts that evolve out of this? I mean, whether it's, sort of the merging of hotels with apartment hotels, or, more focus on, call it the shared economy space by some of the big brands. Do you foresee any shifts in what we view as the hotel business today versus going forward, given some of the nuances associated with people being or preferring to be in their homes generally for health reasons?
Look, I'll give you what I think is the real answer, but also give you what I think is maybe the more interesting answer, which is, let's start with the more interesting. I think it's definitely a moment in time, and I'll talk from the public company perspective first. I think it's definitely a moment in time where I think everybody is rethinking their strategy, right? It's only natural to say, okay, we've just had the biggest shock that nobody ever could have underwritten or planned their businesses for, nor should you. We have to kind of rethink things right now, or at least test the boundaries and see if there are things we should be doing differently. Or if we're a REIT focused on limited service, should we be, bolting on an extended stay platform because that's more resilient now? Or, should we be thinking about urban full service because suddenly that's just really cheap and maybe it's just an opportunity to make money? If we're a branded operator type, should we be, doing more kind of spec investing in, technology related businesses that could be a good hedge, but also the wave of the future? I think all these things are being thought about, discussed. And then my real answer is I don't think anything really changes, to be honest, because I think, at least not in any, significant scale. And look, a large part is any of these things that I'm kind of throwing out there mean deviations from the core, and core competencies, internal expertise, and investor expectations. I think generally public companies have pretty tried and true strategies. They have investors that like that strategy. That's why they're invested. And if they're not invested, they can find somebody else that fits their strategy. Big pivots, through capital expenditure and M&A is often a difficult hurdle for public companies to overcome. Again, you can make the argument now is as good a time as any to rethink that. But for those reasons and a few others, I do think it's highly unlikely. Do you have some, more marginal pivots on, investment strategy? Could you, do you see a REIT do more to team up with a short-term rental company in order to optimize their space or, something like, yeah, I think you could see some of that, but I think it'll be, probably marginal, at best. But it was very much a subjective question. So I don't know, Croft, if you have.
Yeah, no, I totally agree. But I think I would note that I think there's room on the margins for a lot of these guys to do the marginal moves without actually doing anything new. I mean, Marriott already has, single family home platform that they've started to build out. Accor has a number of sort of ancillary businesses. And so people have been dabbling and playing in tech investments, et cetera, all along. I guess the question just is how much more do they go that way on the one hand? And some of that's going to be driven by, how temporary is this? Are people really going to want to stay in a condo instead of a hotel room because they want to avoid the whole lobby and everything else? Or do we get a vaccine in the middle of next year and all this is ancient history?
And then look, then the other spin on this is, right, that's the, we just talked about was the perspective from, say, the listed companies. But I think financial sponsors have much broader degrees of freedom to operate as each investment, is discrete and unique. And so, one example of how a sponsor is thinking about the current environment is over in Europe. We just worked with KKR to acquire a business called RoomPot. And RoomPot is basically think about it kind of like a glamping business. It's a holiday park, camping type setup. It's a very, very large business. And that was just announced only a couple of weeks ago and therefore was negotiated kind of during the last, month or two. And in that case, that was a sponsor saying, this business is affected somewhat right now, but it's actually shining a spotlight on the type of business that we think will stand the test of time, which is people are still going to want to travel. They're going to want to, they might be more prone to want to do localized travel instead of fly to, and they might want to stay in their own isolated cottages, cabins, tents, what have you, more so than in a hotel going forward. And so, we'd rather spend the money now and buy this business. In that case, by the way, all cash, no debt financing, because we just are taking a view and want to put down a bunch of capital toward taking that view. And so I think, look, with sponsors, we've similar to what we talked about with others. We've seen a lot of folks kind of think about the hospitality space and other fringes to play it, what's available and what are new themes to be focused on coming out of this environment and that will continue to be an active dialogue.
Well, and so the RoomPod acquisition, I mean, what was the seller's motive there? It was the opportunity to monetize. Did they need to raise liquidity? Is it combination of the two, or just a great opportunity they couldn't refuse?
That just happened to be something where the seller was contemplating the sale pre-COVID, as it was a financial sponsor that owned the business, PAI partners that owned the business, and so it was kind of the natural point in time in their life cycle to sell, to monetize the business. And so in that particular case, they were getting ready, but ultimately didn't really run a process because COVID hit and disrupted things. But generally people knew that it was coming, and in that case, KKR made an approach that PI ultimately said, yeah, we can we can get comfortable transacting here without, without like a broad, process.
Croft, anything, are you guys seeing or working on anything of similar ilk?
Well, I think there's certainly a lot of interest, and I think that kind of goes into the whole idea of when is when is transaction activity going to pick up? And I think some of that is driven by, some distress, and a lot of that distress is driven by, kind of operating leverage, and a lot of these smaller platforms that are, running a pretty significant cash burn and don't have access to as much capital could find themselves in positions where they want to go ahead and monetize because it just folds them into a bigger platform with a lower burn rate.
Well, and to that point, I mean, I think there's been a tremendous effort by the AHNLA and our members on the Hill to create stimulus to hopefully, help people work through this, both, small business, medium business, and hopefully some other things that can help the real estate side. I think that if you'd asked any of us at the beginning of COVID or lockdown, when the distress would appear, we'd all be wrong. I mean, do you see more shakiness, particularly given the change in the infection rates that we're seeing today? And does that really leave an opportunity to spur some additional transaction activity as either assets or pools of assets go back to lenders, special servicers, other? And does that sort of break free the transaction drought that we're currently in?
I don't know if I would tie it specifically to what we're seeing as far as, increasing cases and that kind of thing. I mean, that's a real time, near term. It's hard to say either where it's going to go or how it's directly impacting. But I do think where we are is we're sort of on the cusp of the end of the 90 days of forbearance that was first granted either, beginning of April or beginning of May. And banks are going to be in a position where they have to sort of make another decision. Are we going to give another 90 days of forbearance, which I think in some cases they will, or are we going to do we need to start putting their feet to the fire and trying to figure out a solution here? And you are seeing more stuff get pushed into special servicing. We've started to see some loans coming onto the market, which I think is the most preferred solution of most of the sort of more institutional lenders is I'm not trying to, foreclose and work this thing out. I'd rather just sell it to somebody else. But that starts the process that sort of greases the skids and as this distress starts to come out. The other thing, and I think Hilda kind of outlined all this stuff pretty well, but you're at the, the PPP is starting to come to its end. The cash burn is starting to had a continual drag. And so there's a number of factors that are coming to bear here where people we're either coming out of it and they're starting to get on the right side of it or the distress is going to come to the surface.
Yeah. And I think to build on that, Mark, to your question around, does this, second wave or, sustaining of ramping virus load, actually in a weird way enhance our expectations of the transaction market? I think what it does do is, to Croft's point, I think it will put more strain on owners in a way that creates more forced selling in a way, either forced selling or forced capital raise needs or what have you. I think, but for the very same reason that we're having that conversation, that's just that much more risk baked into the profile of those types of investments. And therefore you have that conundrum of, you might have more forced selling, but then you've got more uncertainty on the buyer's side. And so, it's not necessarily a narrowing of a bid ask, but look, so a lot of this will kind of play out over the next, 6 months. I tend to agree, right? I think the back half of this year, we'll see some more forced transaction activities. And a lot of that will really hinge upon the risk tolerance of banks and debt funds that hold loans and special servicers on their willingness to engage on continued forbearance or not.
Right. Well, on sort of switching to a different side of the equation, but we've seen some consolidation in, let's say, the service providing business of connecting, whether it's Grubhubs and Eat Takeaway, acquisition. Do you think that this is an opportunity for OTA consolidation or distribution channel consolidation or anything there that may be a different angle impacting the hotel business in general?
I don't, actively cover those companies, specifically, but I'd say there's the setup for some of that, which you would argue these are going to be, revenue starved businesses similar to, brick and mortar hotels and franchise hotel companies. And, competition is already fierce. But, on the flip side, I think distribution was obviously a very topical word in the last cycle. I think it's going to be that much more topical going forward. And so, the reliance upon distribution is going to be key. And so in some ways, there's going to be more demand from the more concentrated base of counterparties for the OTAs. I think for a similar vein, it does kind of create a position of relative strengths for the brands themselves. And I think, I think you'll see a lot more soft brand, franchise agreement opportunities, come out. I think it's just about every day. I feel like I get a press release alert from Wyndham or Choice on, another soft brand, partnership that they announced. These are all distribution agreements at the end of the day. And so, whether it's the brands, whether it's the OTAs, I do think there is going to be more of a need for that, for that service, whether or not that leads to consolidation amongst the OTAs. I think there's a lot of other factors to consider that I'm not sure I have a clear view on.
I agree. I think Hannah's slide that just sort of broke out the ADR and the occupancy track is just indication that, it's going to be the rate that's the hardest thing to drive, which is, pretty obvious to everybody here. But I think that the ability to drive distribution to that, and whether that's using incentives of loyalty programs and things like that, you're going to see a real explosion in the soft brands as people want to tap into that distribution network.
And with that, I mean, so you're right, tapping into the soft brands really helps a lot of the boutique and independent owners and operators. How are the, your clients, call it the larger operating and management companies on the private side handling this, and what are their biggest concerns, and do they see opportunity either to buy other management companies or consolidation in that space?
Yeah, I think on the third party management side, I think we do expect to see some consolidation. I mean, let's take for example, a private platform of that manages 20, 30 hotels for third parties. That there's a certain amount of fixed costs necessary to run that business. In a world where their cash burn is primarily their overhead. Without any real revenue. I mean, PPP and other kind of emergency, funding from the government can last, only so long. I think there will be consolidation just simply out of capitulation or forced selling in a way. And those contracts are worth something. And so if you want to salvage, equity value, you find somebody to be the buyer. So I think the larger, more institutionally capitalized platforms in the third-party management space will come out as net acquirers in this market. Think about that as like an Aimbridge or a Highgate or those types of names. On the branded side, I think for those guys, I mean, the folks that we spend time with, I think you have a lot of the similar offense defense kind of split-minded mentality right now, which is we have our own business to worry about, but we're in the business of trying to grow our brand, and we'd love to do that in this environment because there's never been a cheaper time to buy real estate, whether that's with our own capital, whether it's with a new partner, to work alongside us and be our capital partner. But at the end of the day, we have to, we have to sustain our existing platform right now. So, look, could there be consolidation there? Absolutely. I mean, I saw JP's slide, a few minutes ago talking about, what is 105 new brands since 2015. I mean, there's a lot of new brands out there that, that have a very small base to operate and a fixed cost, to run a platform. And so I think you'll certainly have, some issues with some of those platforms that, that will kind of raise the question of, do I fish or cut bait?
Croft, any view on your end?
Well, I would just agree. I would just add that I think that a lot of those private brand operators they're few and far between where they actually have enough scale to be something that moves the needle for the global guys. And so the global guys are really looking at ways they can drive growth, but they're also, they can develop their own brands to a degree. So they're looking for something that has at least a nascent scale they can build off of. And whether that's a regional brand that they can expand further, or whether it's a boutique brand that they think they can take around the world. Interestingly, a lot of the ones who have achieved kind of that level of scale are backed by very deep pockets. And so the question will be sort of, how much are those sponsors, if you will, or ultra high net worth individuals willing to continue to fund cash shortfalls given the operating leverage in the business?
Well, I guess, and given sort of the dislocation in what's going on here and the time period, which is a big question mark for everyone, what does an ideal look like, I guess, today, both public and private, and what is needed in order to get transactions done other than obviously a big equity check and no reliance on debt?
I think just there's a million different types of deals to talk about. Just in general, I'd say you need a seller who has a unique motivation, whether it's debt maturities, cash burn, and liquidity, or just generational, life's too short, time to move on in this environment. So I do think you need a unique motivation for a seller. I think you need a buyer that's just willing to take a view. Like, we're going to be in a period of uncertainty for the next 3 years, right? I mean, I don't have a crystal ball, but that much I do know. So I think at some point, somebody's going to need to, in order to really catalyze a transaction, whether it's liquidity, preferred capital, or whether it's, an outright acquisition of an asset or a platform. I think it's somebody taking a view that is somewhat unique from, their competitors out there, because there's a lot of capital, there's a lot of money chasing deals. It's going to be somebody that's willing to say, I have a view on urban group. I have a view on Houston. I have a view on boutique lifestyle, right? And I think, those are the two key things. I think the financing opportunity, I think the finance will sort itself out over time. I think there are going to be guys that are willing to take a view that I can fund something all equity now and, feel good about being able to refinance in the next year or two. So that's certainly helpful, but I think it's the first two things to me that I think we'll need to see, really catalyze activity.
I agree.
Great. And do you see anything interesting on the horizon as sort of we wrap up? I mean, what are your takeaways for the audience today and your prognosis for 2021 looking ahead?
Look, my take is, I come back to one of the comments I mentioned earlier, which is when you take a long-term view that this sector is is sort of germane to society, to travelers, that there will always be demand, and that might be disrupted for a period of time, but it will be there. I think you couple that with the fact that there is a lot of capital available, and you have corporates that are rethinking strategies, and we'll get back to 2019 or 2017 cash flow levels at a period of time. I think it's not a question of if, it's a question of when, that there will be more of that growth mindset that leads to deal activity. It'll have some twists and turns along the way for sure. But I think we, and I'm sure Croft would say the same, are actively engaged in all these topics with our clients, and that window of opportunity take on capital or to invest themselves is will expand and shrink every week that you talk to somebody. But the fact that there's active dialogue, I think it means it's there's inertia as we get a little bit more kind of footing on the forward outlook.
I agree, and I think my view to kind of say some similar thing to what Kellen said is that human beings are human beings, and so unless there's a dire situation where we can't get through this, which is going to fundamentally change everything about our society in ways we can't even envision, hotels will be back, business travel will be back, humans interact, and they need to see each other to best do that. And so I think we will come back over a long period of time. People are engaged in stuff, and I think the intensity and the shock and the short window in which this occurred is something that we're all still kind of working out of, and that as we get further and further away from it, even if it's a slow recovery, I think people will have a perspective that will allow them to get back more toward normal business as usual on the transaction front.
Great. Kellen, Croft, appreciate you guys being a part of this in your time, and BHN Group for putting this on, and I'll turn it back to Jeff and Jonathan.
Thanks, Mark.
Thanks, everyone.
Okay, thank you very much, gentlemen. Great conversation, Mark, Kellen, and Croft. Very interesting when we started, we've heard, we're about halfway through this program today, and we've heard several mentions of all of the dry powder that investors have and how they're sitting on the sidelines waiting. And we'll see if this is the catalyst for that money to be spent, because we've heard that over the past few years, the same, the same story. So it's going to be interesting to see that. Now, as we shift on to the next part of the agenda, first want to remind you BHN and the opportunities we have for conferences around the globe. You can see the ALIS family of events there on the left, and Chris Ola coming up in September, and our high cap in October this year. And don't forget, we have our 6x8 top of mind recovery series that that ran for 6 weeks and ended at the end of June. Those are on our website at burba.com. You can see all of those interviews and the interesting commentary from around the world to get up to speed on where we're at globally for the hotel industry's recovery. So next, we have a panel about transformational projects. And as the panelists get settled, as Tricia brings them up live, I'll do a quick introduction. We'll have moderator Mike Magrins, he's a principal of Ernst & Young. Then we have the panelist Kanteya Chitnis from MCR, Ali Hope, the Chief Development Officer from Virgin Hotels, Matthew Livian, the CIO from the Seidel Group, and Shafi Syed, SVP and Global Head of Hotel Development for Equinox Hotels. So I'm going to turn the program over to Mike. Mike, take it away. Enjoy the conversation. Okay, Mike, we're having a little bit of a technical difficulty here, so we'll wait. Tricia, our producer, is working on the sound. So Tricia, let me know when that happens as we wait for that to be addressed. We'll take a couple look back at the early part of the program. A couple things that stood out to me. 2020 RevPAR projected to be 30% lower in 21 than in 19. We are going to see forbearance slow down here at the end of the third and fourth quarters. I think a record level of private funds was something that Hilda talked about, and I thought one interesting statistic that Hilda mentioned. 80 transactions of over $5 million in Q1, 8 in Q2. And finally, JP, the pipeline, 701,000 rooms in the pipeline with 5,600 properties. So very interesting data so far. Tricia, are we ready to go with this? Is Mike online? Mike, can you hear me? Are you still? Mike, are you there? Can you hear? Okay, so let's see here. As we talked about a little bit before, the seems like there's been a lot of discussion about just a recovery and where we're at, and still a lot of room to go. And I'm just going to ask Mike. Mike may be talking. Are you there, Mike? Okay, we're still having some difficulty as we get there. So as Mike's talking about this, let's talk with the panelists. I think Mike, I think we have you. I heard you there. Are you there, Mike? Okay, let's start the panel off with talking. Let's go down the line and just have a quick introduction as Mike gets his, it looks like a substitute microphone set up. So Kanteya Chitnis from MCR. Kanteya, tell us a little bit about yourself, what you do for MCR, and how you see the general lay of the land right now.
Hi, everyone. Name is Kanteya Chitnis. I'm a Senior Vice President on the Acquisitions and Development team for MCR. And I support the sort of larger developments, of which the topic of conversation today is the TWA Hotel at JFK International Airport. It's a 6.5 acre mixed-use development right in the middle of the 5th largest airport in the United States. And, you know, obviously, unprecedented times. I'm sure this has been discussed at length throughout the day today. We're seeing, you know, a lot of, as you mentioned, Jeff, a lot of dry powder on the side from an acquisition standpoint. However, a lot of sort of green shoots in the sense that people appear to be dying to get out and traveling as soon as there is a reason to do so or an ability to do so. And so our focus has been to pursue opportunities that allow us to, you know, build great projects.
All right, Kanteya, we'll jump to Ali Hope here. We'll obviously get a lot more from you about the TWA and what your plans are. So Ali Hope, Virgin Hotels. Ali, tell us a little bit about yourself, what Virgin is up to these days, and how you see a lay of the land right now.
Sure. Thanks, Jeff. Hi, everyone. So I'm Chief Development Officer for Virgin Hotels. I liked earlier, someone mentioned that we launched in 2015. It's been a little bit longer than that since we launched. That is when we opened our first hotel. And during this time, I mean, look, when this all came upon us, we were in a way for the first time fortunate to only have a couple of hotels open. So really our triage was short, sweet, and very pointed. So we were able to kind of take care of that and then move on to what was next and how we were going to address our growth plan going forward. So as Florian said, you know, thinking about all our different options, what are the opportunities in the market? Where do we see consolidation? Where are there opportunities to grow the brand? Naturally, we strongly believe kind of upper upscale lifestyle space that we play in is a good spot to be. And we've seen that in some of the performance data as we've opened up hotels kind of post shutdown. So, you know, we've been focused on, you know, what do we do next? And there was a moment of peace and quiet with less travel, which I think we all enjoyed. Despite what it does to our industry, it was a nice moment in time to kind of think about the future from a different headspace. And then we've been busy opening hotels. So we reopened ALIS first, and then we opened a new hotel in Nashville at the beginning of this month. So we'll talk more about that later.
Yeah, congratulations on that. I know a lot of us are just eager to get on airplanes, just to get out again. Right? So welcome.
Hey, Jeff, are you able to hear me now?
Mike, yes, I can hear you loud and clear. Thank you very much
for your
persistence. Thank you. I'm gonna let you do your job. I'm gonna go to the background. Thanks everybody for being here. Appreciate it, and thanks for your patience.
The joys of technology. I don't know if we're all ready to go back to the office, but it makes our lives easier when technology works. So thanks for filling in there. So Ali and Kantea, thanks for giving your update, and maybe we can go to Matt.
Sure. Mike, can you hear me and see me okay?
I can hear you just fine.
Okay. Okay, great.
I can't see you. That's the only other challenge.
Got it. Let me see the joys of technology.
You tell we're all hotel developers, not IT tech developers.
Yeah, for sure.
There you are.
See me now?
I see you now, yeah.
Okay.
Good to see you.
So hi, everyone. Matt Livian. I'm a managing partner and the chief investment officer at a company called Sidel Group. We own, develop, and operate lifestyle hotels across the country and currently in London. Have a portfolio of about 10 hotels, including a brand that we started called Nomad, which started at 28th and Broadway in New York. Line. We've worked on a project with MGM in Las Vegas, Park MGM, and a project with Soho House in London called the Ned. Look, I think in terms of lay of the land, these are obviously unprecedented times. I think the speed and severity with which this pandemic hit our industry obviously is something that none of us could have foreseen. And so, initially we went through a process of, what I call sort of triage, trying to right size expenses as much as humanly possible, closing those hotels in the markets where we didn't see demand and where we were effectively told to close. And now, in terms of where we are, we're starting to sort of reopen our hotels. We've reopened 3 of them and are definitely seeing some positive momentum, although it's been sort of on and off. But we think there's going to be incredible amounts of opportunity coming out of this. If you just think about all of the assets and sort of companies that are going to be cash starved, our business was not created to be a zero revenue business. And so focused on that and how we sort of capitalize coming out the other end of this.
And Shafi, I know you're in London. Thanks for hanging with us so late. How about yourself? What have you been up to during the pandemic? And how was your trip to London?
Hey, thanks, Mike, and hello, everyone. Yeah, so I'm normally based out of our headquarters in Hudson Yards in New York, but the last few weeks I've been in London as we're looking at a few projects here in Europe. Well, to answer your last questions, the trip to London was quite surreal, actually. The flights were nothing like what you experienced, mostly empty, no airport lounges, no hot food on flights, and wearing a mask throughout. So certainly travel experiences have changed in the short term, and hopefully, but it was interesting that there was a lot of the co-travelers were very adaptive to this environment, and everyone was kind of pretty accepting of what we're experiencing. But to give you a background, I had global development for Equinox Hotels, and we are an evolution of the luxury fitness chain Equinox into the hotel space. Our positioning is in the luxury lifestyle space, and our aim was to seamlessly integrate the sort of Equinox urban fitness, wellness, F&B, high performance living experience into a luxury lifestyle hotel experience. And so we opened our flagship in Hudson Yards last summer, and it was extremely well received. We're very pleased with how that launch went. Obviously, it's been only 7-8 months into that when COVID hit us, and so we like many other New York properties, we shut down from April and remain closed and wait for the demand to sort of come back up. And New York's probably one of the harder hit cities, and just because of the way demand works there. But as Ali mentioned, and on the plus side, our operational exposure and our operational risk is limited to that Hudson Yards, New York property, and that's our flagship. So we're not going anywhere. In fact, we've got 5 other projects on the go. So from a lay of the land perspective, certainly it's a good time to be in the development cycle where you've got projects opening on the other end of 2022 and beyond, if you have to believe what the analysts say when the world returns back to 2019 numbers. So yeah, look, like everyone else, we are in growth mode and continue to look forward to doing more projects in the future.
Yeah, so let's stay with you, Shafi. We're going to get to why all of you and how all of you have been thinking about transformational projects. But before we do, let's keep talking about how COVID-19 has been impacting either newly launched projects like Contea with TWA and ALI with Nashville and Vegas. How is it impacting the Equinox growth in the short term? And you've only been open a year in New York, obviously not up to stabilization. How long will that take now?
Yeah, I think it's hard to tell about the stabilization, but we certainly think that the ramp up is going to be gradual over 2021. 2020 is probably going to be a wash, like many others predicting, and then over 2021 and 2022, depending on how government's vaccine consumer confidence returns, we feel that we would ramp up back to where we need to be in the next couple of years. But just kind of going back to the projects that we got on the go, this project has been 5 years in the making as a brand and as a development in Hudson Yards. And as we started to get this off the ground, we were always and continue to look at other developments. So we've got at the moment 5 projects on the go: downtown LA, Chicago, San Francisco, Santa Clara, and Houston. And so just kind of talking about downtown LA, that is our next opening, which is scheduled for 2022. It's been pushed back by a quarter, which is not a bad result given what's been happening to a lot of other projects. So the openings are delayed by 8 quarters. So we opened last quarter of 2022. So that's really the only impact. Probably a different scenario for the other projects, which are going to be slightly more delayed, and it's less to do with planning or entitlements, and it's probably more to do with us reviewing everything in terms of just making sure that we're taking advantage of construction costs if they come down, financing. But we continue to move forward on these, as these are prime locations. Sponsors are long-term hospitality owners and developers, and I think the real impact is delays by a few quarters, if anything. With some of the other discussions in international markets, like you look Toronto, Miami, London, Milan, Tokyo, we're having conversations there, and I think some of the previous speakers alluded that there's a lot more offensive tactics taking place where people are moving forward with their plans and hoping to take advantage of it as they come out of the crisis in the next couple of years.
And Ali, what about you on the delay of projects or can you comment on the opening of some of the new projects?
Sure, yeah. So we opened Dallas in December of last year. And again, as I mentioned earlier, that was our first hotel to reopen. I think that there was a huge push there to get it back open by our owner and partner, which we supported, of course. And we've seen F&B ramp up really substantially to the point where we've had to hold people back. I think showing that people have a real tendency, especially locals, because it's definitely not corporate transient demand filling up the hotel. It's impacted our outlook for the year. Of course, 2020 is, RevPAR is down over $100 to what our original forecast was going to be. So I think numbers wise, particularly in rate, in occupancy as well, are both down. F&B, it's just a little bit unknown. So Dallas is doing, relatively well despite everything. New Orleans, which is another project we topped off 2 weeks ago, we saw very minimal delays there, a couple weeks, but really still on track to open in June of next year.
Okay.
Vegas, we shut it down luckily in February of this year for a big renovation. And we're on track now to reopen with a partial opening in December. So a lot of precautions taking place there. I'm sure you've read in the news what's happened at other Vegas hotels. But definitely still, on track to open, and hadn't seen too much of a hiccup there, other just more management oversight. In Edinburgh, our first European hotel, there we've had a few months delay. So we saw a little bit more setback there. And New York, obviously, construction was fully shut down. Saw a delay. And then Miami and Philadelphia, we're in design on those projects. So definitely slowing down, because I think the insight into, financing markets, as Hilda said earlier, we definitely see that. So kind of until we have more visibility there, we're going to probably stay in design. I'll anticipate a decent delay on those projects. And then at other new developments that we had soft deposits on, we decided to pull out of for the time being with the uncertainty in financing. So I'd say it's the ones that are on their way, and if the market continued to build, it hasn't really caused much of a setback for us there.
And Matt, you've got the Nomad in London and the Line in San Francisco. How have those projects been impacted?
So I think similar to what Ali was saying. So in London, construction actually never stopped, but definitely slowed down due to social distancing measures. And between that and supply chain disruptions, I think we probably lost 3 months or so on that project. Not deadly in the grand scheme of things. So we're still targeting a December opening for London. And we're working on a new build in San Francisco on 5th and Market, 240 rooms connected to about 200 condo units. Construction halted there for a bit, but we were able to continue advancing sort of model room and a couple of other things. And actually, one of my partners who leads development for us had the virus and felt safe traveling, so was able to actually move design there forward. And we probably lost, I want to say 3-4 months there as well, but construction is back on and moving ahead.
Very good. And Kantea, you have one of the largest projects that we were all supposed to be at today or this week. Talk about what's going on at the TWA Hotel and how, as an airport hotel or just a hotel in general, this crisis has impacted that asset.
Yeah, thanks, Mike. And I wish we were all grabbing cocktails on the Connie right now, but unfortunately, COVID has certainly impacted the airline business, and we're obviously situated right next to Terminal 5. We opened May 15, 2019. We were in the process of ramping up, and we saw a 98% year-over-year decline in JFK airport traffic. You were seeing roughly 130 flights per day when, the year prior, you were closer to 1,200. So what we saw was a steep decrease in the corporate and transient rated demand. No events, no leisure travelers coming through. What we have seen is a lot more airline traffic. We've been able to kind of pivot, and as the panelists have mentioned, it's really a cash management game at this point. Our underwriting and our previously kind of perceived notions of how this property would operate have probably been kicked back several quarters. But what we have seen is we've seen an increased demand in the day stay product, which is a 4-hour room that we sell that gives you access to certain amenities such as the rooftop pool bar. And as has been mentioned in kind of previous panels, that signifies to me that people are dying to get out there and travel. And we've seen an increase in demand for the product just to experience something. So we're doing okay now across MCR, roughly 90 hotels. We've seen a rebound. We have both a independent business and a limited service business. And we've seen the limited service business on our side, which is a lot of tertiary and secondary markets, rebound to about 66% occupancy. So we've experienced a little bit of a rebound from the low periods in April 2020. And TWA specifically kind of went straight down, and we've been able to incrementally build that business back up by going direct to airlines and reaching out to different revenue sources.
Sure. Well, it sounds like you all are weathering the storm here, and so let's get to the meat of it. All of your projects were transformational pre-COVID-19, and now you're probably thinking about how can they be transformational going forward and be feasible and attract the right customer. So, Matt, let's start with you. You guys have a unique approach to development and assets that you look for when you're investing and managing. And why is that so important? You talked a little bit about the next hotel is going to have a residential component. What makes a hotel transformational to you and to Seidel?
Well, transformational is a big word, but I like to think our hotels have all been transformational in their own right. But look, for us, I think you touched upon it. We do have a different approach than most of the players in the lifestyle hotel space, in that our heritage is really as a sort of development company. And so, we've always thought that if you look at consumer tastes and desires, they've been shifting for some time towards highly localized experiences, unique, idiosyncratic experiences that are specific to the building and neighborhood that you're in. And so rather than sort of approach the world with a brand first mission of growing all of our brands in every market across the US, we've been more opportunistic, trying to find interesting pieces of real estate in neighborhoods that maybe others haven't yet discovered, or the brands wouldn't touch for one reason or another, and coming up with the right sort of story, narrative, branding solution and design for that opportunity. And so I think if you look across the projects we've done, they've ranged all the way from, we started a hostel brand called Freehand, where we saw a hole in the market, in a part of the market that was highly fragmented, where no one with any bit of sophistication, design, capital was operating in the US, and started a brand called Freehand, all the way up to Nomad, which is, our take on the grand European luxury hotel. But I think generally, if you look across what we've done, it's all been about what is the right response to this neighborhood building and piece of real estate. And that's what I think has made us unique.
And Ali, what makes the Virgin Hotel concept, brand, how does it enhance or transform a project?
Yeah, I think I'm with Matthew. I think we would like to think that the brand itself and what we've set out to develop, and now we're in the process of growing, is transformational. But as it relates to where we sit today, I think some of the pleasant surprises were the way our rooms designed actually is natural for social distancing. We have a two-chamber guest room where there's a barn door that divides anyone servicing the room. So room service, for example, and the guests to stay behind a barrier. And so that was a design for privacy, and this concept of really taking our app and the technology to put the consumer in control of their experience. So we've always set our app up to allow people to order food anywhere. So basically room service anywhere within the hotel delivered to you. All your controls on your own device, so you're not touching a lot of different objects in the rooms. So I think that we're just seeing probably more of a need for what we've set out to do now more than ever. And the technology being a big part of it. We have this program called the No program. So at Virgin Hotels, we don't necessarily have a points system, but we have a preferences program, which is called the No. And we've actually had record number of signups just this past week with a number of members. I think just proving out what the customer is looking for today, which is connectivity, programming, really adapting the technology that maybe our industry has been gradually developing, but now this will force the customer to kind of adapt new practices or new habits that maybe they weren't before. So that's across all of our projects. You know, we do the Lucy app and all of our technology in the No program. I think one thing that we've taken on, which I mentioned earlier, is the Vegas project is definitely transformational for us. That's a partnership with Hilton as well. It's over 1,500 rooms. Has a lot of meeting space, which will be interesting as we see that business come back. But a lot of restaurants, and also AEG is a partner there doing all the live music and venues. So I think for us as a brand, that's transformational. I think we're seeing it be a really great response to what we're doing there and the kind of integrated resort concept. So I could see us doing more of that while we continue to do the 200, 300 room urban and select resort markets.
And Shafi, you and Equinox have to be located at the core of one of the largest transformational developments on Earth over the last 20 years. How important is that to be part of a larger project, and what is the hotel bringing to the table?
Yeah, I mean, we're really proud to be part of the anchor, one of the anchors of the Hudson Yards development, which is in real terms a transformational project, because the objective was the regeneration of the Chelsea and the Hudson Yards neighborhoods of Manhattan, which stretches over a 28-acre real estate development. And it is the largest private mixed-use development we undertaken in the US. And it's also an architectural marvel because it's built on top of a platform that sits on an existing train station, and that never stopped working whilst this development was taking place. So we opened as part of the first phase in 2019, which is really more than just a hotel. We are the anchor of the development, but there's office buildings with tenants that include Facebook, Amazon, BlackRock. There's a true sort of cultural facility that includes the shed, the vessel, which is a permanent art installation. So they've really created a new neighborhood in that location. And what we bring to that is really, it firstly transformed the neighborhood into a true live, work, dine, shop, play, workout experience. And we as a hotel, which always must have an Equinox Fitness Club at the heart of that hotel, creates additional footfall into that neighborhood. So you get anything from 2,000 to 4,000 members that are members of the fitness club that activate and socialize the hotel, but also activize and socialize the public spaces of the neighborhood where we are. So if you're a room guest checking in, you truly interact with that local community. And to Matt's point earlier on, it's really bringing the neighborhood into the hotel and into that development. So it's very exciting for us to be part of that. And obviously, as we grow into other developments and other locations, we hope to bring that same buzz into that neighborhood.
And Katea, talk a little bit about the relationship between the airport and the hotel, and how you feed off each other, and why it's 1 plus 1 equals 3.
Sure. Yeah. So I guess to start off, the TWA hotel is obviously an adaptive reuse of the TWA Flight Center, an iconic masterwork built by Eero Saarinen in 1962. And when the project first came to us, the building went dark in 2001. The Port Authority of New York and New Jersey had been looking for a developer, wasn't quite sure what to do with it. The building was almost bulldozed twice by developers as JFK brought on T5, started modernizing the airport. The building was saved by the preservationists. It became the youngest historic building in 1993 by the city of New York. It's on the National Registers of Historic Places. And so what we saw in the TWA hotel and in kind of the vision of developing it is that we had an existing celebrity for the project. We saw New York at an all-time occupancy. There are other airport hotels. They're not really located in a way that's easily accessible.
Sure.
So what we thought of doing was, why don't we make the TWA Flight Center the celebrity of the project? Give people a story and a reason to kind of walk through this masterwork. And what it ended up being, and the reason it's transformational, is it became a very ambitious public-private partnership. 100% funded by private dollars, involving 175 firms working on the project, 22 government agencies. If you've worked with one, that's usually enough for some people. And over 4,000 people bringing this to light. And we based the deal with the Port Authority of New York and New Jersey is we put in infrastructure that can help JFK get back, get flying back into the 22nd century. Ironically, by going backwards and delivering an experience that you could find in 1962, when Howard Hughes, who before he went bananas, was flying TWA and doing that. So I can go on and on about the project itself. JFK, as Governor Andrew Cuomo announced in October of, I believe it was 2016, is undergoing an ambitious redevelopment plan, billions of dollars, which originally would take the capacity, 65 million people fly through JFK each year. They'd like to get that to 90 million people by 2025. Obviously, COVID impacts the development of that. Do I think that in 5 years, people won't be flying to New York? I don't think so. So if anything, it's extended this. Our relationship is to provide JFK and New York, frankly, which is the first place that people come to when they immigrate into the country. For a lot of people, the world-class experience that they should get at a modern airport. And that was sort of the symbiotic relationship that we discussed with the Port Authority when we committed to the project.
Yeah, it all worked out. Matt and Shafi, you guys both touched upon mixed use. Matt, you talked about residential. Shafi, you all have a gym, of course, or will have a gym, the Equinox brand in your building. How important are those other uses, especially going forward, not only to offer different amenities and experiences, but to offset or enhance the feasibility and the returns for investors? So maybe Matt, you can start.
Sure. I would say, pre-pandemic, we were definitely looking at and talking about a lot more mixed-use projects, whereas historically, mixed use in the hotel environment was thought of as high-end condos. We were having a lot more discussions about doing office, rental, furnished rental, other product types, and I think as there's been this hotelization of all forms of real estate, people and developers have come to realize that having a hotel and all the amenities and placemaking and sort of community and culture that brings provides for premiums in the office environment and in the residential environment. So that's why I think you've seen more and more mixed-use projects, and why I think once sort of development comes back, you will continue to see it, because you can not only sort of look at the return on each component on a standalone basis, but you get some juice from the premiums that well-executed hotel provides.
And Shafi, do you see your mix changing between residential, gym, hotel going forward?
Yeah, certainly. I think we started off with the mixed use project, and I think of the other 5 projects that are on the go, 3 of them are mixed use developments and the other 2 are standalone hotels. But I think everyone knows this, but really the role that a hotel brand can play in this is really 3 or 4 things. Right? You can add a halo effect you add premiums to the real estate values, whether it's rented residential or even just bumping up the office and commercial rates. In a retail-led mixed development such as Hudson Yards, which has a mall, it helps create organic footfall, both through the hotel and through the brand's own impact. So some brands have a strong draw through F&B and nightlife offerings, which provide a reason to visit and drive traffic into the development. And as an Equinox hotel, we have the unique advantage of sort of having a strong motivation for visitation, a natural one, where all Equinox hotels have the fitness clubs integrated into the hotels. So those members who live in the local neighborhood, they really are creating footfall into the mall, into the retail environment, and driving more spend. So yeah, I mean, we love mixed use. We think that is definitely in the short term post-pandemic, the opportunity is going to be much more hotels integrated into mixed use with branded residential for sale or just even extended stay.
And Ali, what about Virgin?
Yeah, I think something interesting to add, when we sat out and took a step back to think about all of our revenue streams, we were thinking, gosh, it would be nice to have some kind of membership or something that's, consistent, reliable revenue. But interestingly enough, just in Chicago, we were talking about this with our team the other day. That hotel has outperformed its competitive set because it has so many amenities self-contained. So I wouldn't classify it as a mixed use development, right? It's a hotel with several food and beverage outlets and a fun rooftop. But it's been, performing really well because it has everything all encompassing within one destination. So I think like Nashville, which we opened, has a rooftop pool. All of our hotels have music venues, et cetera. So all of our hotels are kind of designed that way. And I think they're going to fare better than I anticipated, actually, given the results we're seeing with our open hotels. As far as residential, we've gone down that road and looked at it. We're staying true to kind of what we are, which is a lifestyle hotel company, and focused on that.
Right. Kantea, for your future projects, how important is something besides hotel?
Yeah, so I think from my perspective, and we've seen this both at TWA and the Highline Hotel, which is a hotel that we own on 21st and 10th in Manhattan, is partnering with great products and great companies, and providing a kind of a differentiated experience, as some of the other panelists have said, that is local in nature, has been a great strategy for us. We, MCR, are, I would say, are great at running and owning hotels. We don't really have the expertise to execute on, fine dining, on gyms, on a variety of other products that, to be competitive, you need to provide to your customers. And so our approach has always been, let's find great partners, such as John George at the Paris Cafe at TWA. We partner with Intelligentsia Coffee at the Highline, and let's help them build great experiences, such as the Connie Bar at TWA, which is a fully restored 1956 Lockheed Constellation, or the London Bus that we just opened at the Highline, which is a double-decker London bus in our garden at the Highline Hotel. I think that these experiences and differentiated sort of products that you can offer your customer eventually allow you to build in the rate that enhances the profitability of the hotel.
So I'm sure all of you saw the number of brands that was up on that slide since 2015 that have come to market, and there's so much competition for you all. And I'm wondering if you all have a point of view on how many brands become irrelevant, how do you keep your brand relevant, what do the customers want to see? So Matt, you guys seem to figure out the special sauce. What keeps your brand so relevant?
Well, look, I think today I'll relate it to what's going on today. I think it's important to obviously pay attention to what consumers want, and all of the health and safety measures that are going to make people feel comfortable traveling again. But at the same token, you really got to keep your eyes on the prize, which is how this all is going to look, post health crisis, and making sure that you're not sort of shooting yourself in the foot and killing what made your properties and your brands really special and unique, and what people really loved about them. And so, for us, our hotels, we've always had a point of view of who our target customer is, who we're trying to. We don't build hotels for the masses, but we build hotels for a particular customer, and those customers we feel like love us, and come back again. The Nomad in New York, our repeat guest ratio, 50%, exceptionally high, and we've built a lot of loyalty through doing that. But I just think if all you do is listen to these webinars and what's going on today, and all you're focused on is how many times each surface is cleaned, I think you run the risk of sort of losing what makes all of our hotels so special.
Yeah. Ali, Matt said something that I'd love your perspective on. Have you gotten a sense of how important the cleanliness is and a brand is to a traveler post-COVID or during COVID?
I mean, I kind of laugh that now some people talk about cleaning fees, and I'm like, I'm pretty sure our guests think we always clean the room, but look, I think it's more important now than ever that the customer trusts the brand, right? So whether it's a local brand and it doesn't necessarily have scale, or it's a brand like Virgin that has multiple business lines, our customer, it's pretty incredible. So we have about 53 million customers worldwide. And the propensity to try other Virgin brands is over 80%. I mean, it's this repeat kind of love for the brand. And as I've been here for how many years, the one thing that I keep coming back to is they just trust Virgin. They trust Virgin's going to take care of them. They trust that they're going to think about the customer when making decisions about the customer's journey and experience. So I think, look, that's specific to Virgin, but I think that goes industry-wide. I saw Kevin jumped on here. I know Hilton's made a big stance on what they're doing in terms of cleanliness and their approach, and a lot of other brands, and H&LA has been a huge support. So I think in general, the customer trusting our industry that we're going to do the right thing and we're looking out for them is key. And I think branding is one way to help drive that home.
Yeah. Shafi, point of view?
Yeah, I think I'll just talk about our relevance as a brand in the marketplace, which is a pretty crowded brandscape today, especially in the sort of lifestyle or the luxury space. So we kind of picked that luxury lifestyle segment, and for us, like others on the panel, they have a strong brand following. We've got the Equinox member base that is almost fanatical as far as following goes. And so we had to really create even pre-COVID, but more relevant post-COVID, the product and the experience needed to have a true point of differentiation. And now I think post-COVID, guests will certainly, when you want them to spend their dollars, they put a lot of value in those experiences that really are genuinely authentic, genuinely credible, and most importantly, I think have some improvement of their lives. So when we were developing the Equinox Hotel brand, it took us over the last 5 years. We were fortunate that we had this 30-year history and credibility of the Equinox Fitness brand, which we leveraged. And we found that there was a gap in the brandscape where consumers were really looking for a hotel experience which naturally integrated health and wellness, not in a resort, wellness and leisure spa-focused experience manner, but when you're on a holiday, but on a regular basis, like high performance living is our mantra. And so bringing that urban fitness experience into a hotel environment, but also integrating F&B programming, not just in terms of healthy eating like a kale salad way, but really working with celebrity restaurateurs and chefs who created destination dining experiences like Steven Starr's Electric Lemon and at the New York Hotel. So once it opens, I'd love you guys to come and experience that. But really creating an experience where consumers put a value on that. And even from a sponsor's point of view, they want to create projects which bring highest efficiencies and return on their investment. So we picked that segment. We knew that that's where we could make a difference.
Shafi, I think I just learned a new term, brandscape, so thank you for that. I thank all of our panelists, Ali, Matt, Kantea. It's been a pleasure catching up with you all and seeing you, and back to you, Jeff.
Great. Thanks, Mike, and thanks, panelists. Yeah, very interesting conversation. You know, I think it does boil down to that fundamental idea that a hotel stay is an experience, and transformational projects certainly enhance that experience and take it to a different level. But that's going to be more important than ever as the industry starts to recover from, from this virus and people get traveling again. That experience is certainly going to be more important than ever. So thank you to all, and thanks for working through the technical difficulty, Mike. You were a trooper, and we really appreciate you hanging in there and getting it figured out. Okay, so we are in the home stretch. If you could advance to the next slide. There we go. Thank you, Razy. So again, I want to thank our sponsors. It's been a fabulous experience to work with them over the course of the last few months as we prepared for this live, and then again, virtually. So thanks to all of our sponsors, AHOA, Davidson, MCR, Virgin, Access Point, Hall Structured Finance, HWE, McNeil Hotel Company, Stonehill, and Wyndham. So with that said, as we are transitioning here and you're coming live, we've got a great final panel as always. IREFAC, the financial gurus tell it like it is. We're going to get some great insight, probably some fun conversation. I know Michael Murphy is always eager to bring out the fun in the conversation. So, Michael, rather than me introduce, it looks like everybody's active. So I'm going to turn it over to you to take us to the end here. Michael.
Okay. Hey, great. Thanks so much, Jeff. It's good to see everybody. We're not sitting around the table looking at each other face to face, but I guess this is technologically second best. Jeff, I'm a little concerned that I'm looking at you now. Is that the way it's supposed to work?
Yeah, I think you're doing fine, Michael. Yeah, just
okay.
keep on moving.
Great. Hey, well, let me start out. Obviously, we're several months into this catastrophe now. Things look a little different than they did when it first began, but I think that hotel owners and operators have responded as quickly and as efficiently as they could have, some by drawing down their capital lines, some by reducing their corporate overhead, some by not paying themselves, and some by not providing some of the services at the hotel level that guests have become accustomed to, whether it's overnight cleaning or free breakfast and so forth. So for the brands, let me just start with Tony. People have saved a lot of money operationally on making some of those cuts. Are those going to be reinstated the instant things begin to improve, or can you see Marriott, maybe accommodating a prospect where you would have grab and go breakfast and maybe optional housekeeping going forward?
Yeah, it's a good set of questions, and I'm not sure there is a single answer. We're obviously operating in 140 some odd countries, and I think it, as is often the case, the answer to those questions will be driven by what our consumers want. In some ways, I think a lot of the questions you ask Kevin and I, we can almost parrot each other. But I think the brands in particular are focused on building confidence. Certainly as a threshold issue, we've got to build confidence for our associates that they're comfortable and they're working in a safe environment. And then we've got to look at the range of emotions that our guests have. There are some that are very skittish about travel and are looking to the brands to help inspire confidence. At the other end of the spectrum, you also have challenges. We're having lots of discussion about guests and masks. And in certain markets, you wouldn't know there was a pandemic. It is really difficult to get the guests to embrace the notion of masks. And so will some of these changes be sustainable? In certain markets, perhaps. But you pivot to markets like mainland China, where our buffets are doing record volumes, and there's a wage and service model there where you don't have to worry about guests handling, serving. Really vary pretty significantly based on the specific market and what the customers are telling us in that market.
Yeah. Kevin, you have any different thoughts on that, or?
No, nothing different. I mean, obviously that is going to be the same for us, and it is going to vary market by market. I think the only thing I'd add is, you know, as it relates to the US, there's obviously, I think Tony said it initially, and he said it well, it's going to depend on the standard and on the service. And I think as it relates to the US, particularly where most of our business still is, you sort of think about it short, medium, and long term. In the short term, it's pretty obvious. You know, there's no buffets and things like that. We're doing, you know, we're taking down a lot of standards because, especially in the big hotels in the big cities, it's sort of impossible for the owners to stay afloat any other way. And then I think, and at the moment, anybody who's traveling understands what we're up against and is going to give us a break, right? So I think that's pretty easy, and everybody's ending up in the same place. Then I think you sort of have the medium term where some of them are going to come back, right? And some of them aren't going to come back. And then in the long term, the ones that'll come back are the ones that the customers will pay for, right? And so we understand that, you know, we're nothing without our hotel owners, and that the model has to work. You know, we don't grow if our owners don't benefit, you know, are not profitable, and if our owners don't invest in new hotels, we're not going to grow, right? So the model has to work. But that said, our job is to make sure that we maintain, particularly for, you know, Tony's company and my company, since we're both on this, we're both, you know, the premium players in the space, right? And there are others who are premium products as well, but we're sort of the premium products in the space. I'll speak for Hilton. We can't really afford to lose those premiums, right? And so we're going to be super open-minded about it, and we're going to test and learn along the way. We're going to try things with our owners where our owners say to us, hey, try, you know, housekeeping is a good example. Let's try opt-in on housekeeping and see how that goes. And let's try taking this away and see how that goes. And we try to always force ourselves to be really collaborative with our owners and really open-minded. And we sort of say to them, hey, listen, you know, no idea is a bad idea, but at the end of the day, whether it becomes, you know, a permanent brand standard or not is sort of up to us. And we're going to draw the line at things, you know, hopefully we're going to get rid of a bunch of things that we've been doing for a really long time just because we've been doing it for a really long time, and the customer doesn't really care about it and thus won't pay for it. And then the things that the customer really does care about and is willing to pay a premium for, that's where we're gonna say, okay, this one stays. And I think the process of figuring that all out is going to be a long one, and it's going to ebb and flow with the market, as Tony suggested. It's going to be based on how consumers are feeling and somewhat what they're willing to pay for.
Yeah. And Michael, I think it's a good question for Neil too, because certainly for Kevin and I, you know, we live in this world where every day we try to solve this Rubik's Cube. And that Rubik's Cube is aligning the interests of all our constituents. As Kevin points out, we don't grow without our owners and franchisees. They don't thrive without loyal guests that allow our brands to drive premiums. And so and then you obviously have brand standards, and you want to enhance and build equity in the brands. There's probably never been a more challenging time to solve that Rubik's Cube than we're in right now, because those interests are even less aligned than they have been over the last 7 or 8 years.
No, I agree.
I'd argue maybe they seem to be less aligned. I think they actually are. I think they actually are perfectly aligned. Maybe Tony and I have to balance the long term a little bit more than the short term, right? Because of that brand equity that he mentioned. But I do think there's been a lot of discussion in the industry about interest being out of alignment. And I don't actually agree that interests are out of alignment. You may have a little bit of a short term versus long term focus, but our interests are perfectly aligned. And I would say to our however many hundreds of owners we have on the phone, you know,
Well, we'll see, but I think.
And we have one here, so he can talk now.
There are times. I would say just to that point that, I think that both Kevin and Tony's points are right on. Like, I think we have seen more so than any other previous cycle, more responsiveness, more sensitivity from the brand companies to the owner's plight this time. I think in some ways, like, this crisis has been horrendous, obviously. It's been more painful than any other one that the industry's gone through. But one of the silver linings, and it's probably not even appropriate to call it a silver lining, but is that it was even-handed. This hit the entire, not only the entire world, but all industries. It hit owners, it hit operators. Everyone had to respond to a zero revenue environment. This wasn't, we've been in this business, we've started as a family business 35 years ago, and we've gone through terrorist events, we've gone through 3 Mile Island, a nuclear meltdown near one of our properties in the 80s. You go through high interest rates, you go through disruptions in particular areas, and each time it felt like, oh, this is only happening to us, or it's only happening to a small subset. This time it is happening across the board. And that has led us to believe and us to feel, and I think it's not only Hilton and Marriott, but even the other brands have all stepped forward and been much more open-minded and responsive to owners' concerns. I think it goes from brand standards to new ways of new technologies, new protocols. We will see, I guess, how long that will last, but I think most owners feel like through the conversations they've had with the brands realize that this is not a short-term issue, that this is going to be a year, 2 years, maybe 3 years to kind of get back to some semblance of normality. And so we are, as owners, we are expecting brands to continue to be open-minded and supportive of these new ways of approaching it. And I would say that so far, and not just for us and our company and our brands, but all other owners I've spoken to, they've all generally been almost surprised how easy it has been to work with the brands at this point.
Yeah, no, I think that's the same feedback that I've heard from property owners that I deal with. Neil, you've been in the news a little bit. You were one of the companies that acquired and then unacquired some PPP money. You have taken a hit to your personal salary. Your board has taken a hit to their compensation, or has done it in a way other than cash. Have you been rewarded for those efforts in the public markets?
I think so. How I would put it, it's how we've been, in terms of the cuts we've made internally, we went through deep operational cuts out in the field, cutting almost 80% of our total operating expenses. So it was not even a question in our mind about cutting internal corporate SG&A, and we made some very severe reductions there internally for us as executives as well as the rest of the team. But what that reward us, maybe not in the kind of public stock price, but it made it very clear to the lending community and our other stakeholders that we were doing all that was possible in an environment like this. And we do think that gave us the ability to renegotiate and our credit facility in more favorable terms. It gave us 18 months of kind of runway, gave us some covenant relief. In terms of the stock price itself, or actually before I get to the stock price itself, in terms of the PPP, that was the reward there, I think, was just not being on the front page of the newspapers and not having a target on your back, for the coming months, whether that be from shareholders or lenders, or whether it be from employees or competitors or other stakeholders that might be out there. So I think that was, once it became clear that the narrative changed. You remember in the beginning, they were using the Small Business Administration as a technology to get the capital out to as many employees as they could. In that case, it was clear that I think most of the public companies did pursue it at that point. But once the narrative changed and it became, hey, this has to be for last resort capital, as public companies, we do have other ways of accessing capital, and our lending community has been supportive and the like. And so So I, wish there wasn't the fits and starts because we put a lot of effort into getting the capital. But once the narrative changed, it was very clear in our mind that it didn't make sense for us to take it. But the stock price, just the final point there, I think is that's going to take some time to recover. Is it a fair price for what companies are worth today? Not at all. But it's tough, I think, for not as hard as it is for retail, but lodging is still down 70, 80%. And in that kind of environment, I think it's hard to look for a immediate stock price rebound. And so not rewarded, but it makes the next 12 to 18 months much easier.
Yeah, it looked like the press originally, in its traditionally exceptionally lazy form, basically reverted to a 2009, 2010 kind of narrative over what had happened, as opposed to this was sort of a government mandated shutdown versus some failure of management to have kept these ships right. So you could read some of the same stuff. Mark, obviously the transaction market is not humming at the moment. In its traditional way, very hard to value assets, either coming or going. What are you seeing in the marketplace today, and what are you doing to help your clients?
So we're really doing three things. We are selling hotels. We've got a couple large deals done that have been announced. We are getting financing, albeit very difficult and quite expensive compared to where we were before. But the thing we're spending the most amount of time on is lining up runway capital for owners. So because of the global pandemic, every single hotel in the entire globe has been impacted by the pandemic. Every single one, not a single one has been unimpacted. Secondly is every single hotel needs a capital infusion. And so the owners can put that capital in, but there has to be capital advanced in the asset. So, the question is that capital, does the owner have the capital? And two is the owner's capital more expensive than what they can access from the market? So if you're a developer, for instance, your equity is a 30, 35% IRR money. It's the highest octane money out there because it's creating a new value, and the developers bringing in investors from the outside at lower levels of capital. Well, there's an institutional market out there that can provide capital fairly efficiently given the environment, and the quantum of liquidity is shocking, and it's very different from the Great Recession. And the greatest illustration of that is probably the Dow Jones hitting 26.5, or today. I can't rationally justify such a number other than just the amount of liquidity sloshing around out there, and bonds that 0.6 of a point aren't that attractive. So where do you go? You go to the stock market, and then you start to look at alternatives, and some of that money flows into real estate. And so as a consequence, there's capital available to owners that need it at a more efficient price. And we're spending a lot of time, probably half our time on those kinds of assignments.
So that, you mentioned the Great Recession. A whole lot of capital was raised at that time, more or less on the same premise that hotels had been severely impacted. They were slower to recover. There's an opportunity maybe to come in and make some terrific equity investments, but that's how we got debt funds, because there was too much capital chasing too few equity opportunities, right? Do you see that happening again, that there's just too much money for maybe too few opportunities of scale?
Well, I think the difference there's a lot of differences, and we always tend to, fight yesterday's war. And if you would have asked me 2 months ago, and you would have said, are there going to be a lot of REO, a lot of foreclosures, a lot of properties coming to market? I would have said, no, go back, look at the Great Recession. It didn't happen. Everybody extended. There wasn't a lot of product on the market really to 2012. And 2 months ago, I think I would have been wrong. And, you know, we spoke a few weeks ago to a company that owns the retention bonds on over 1,500 pieces of real estate. And about 400 of those have asked for forbearance. Almost half of those were hotels. And what he said was the first 90 days forbearance was fine. It was like easy to give because we went and tapped the reserves. So we kept the interest payments current. The owner didn't have to come out of pocket, and that's fine. But going forward, we're not going to make any modifications, and we're certainly not going to do any extensions without a major interest reserve, without a CapEx reserve, without perhaps a pay down of the loan, without perhaps an increase in the interest rate. Because if they don't want to do that for an extension, then we'll just take the asset. We think there's enough liquidity out there. We can cover our loan basis on it. And so as a consequence, you know, we've probably in the last month, 80% of our BOVs have been for lenders.
Yeah, I think the reason you have debt funds now, Michael, is actually financial sophistication. I actually think that those funds are a better source of the capital for that part of the capital stack. So I mean, you know this because you're in the business, but in the Great Recession, you had CMBS that went all the way down through the 80th cent or whatever, and the bottom part of that capital stack was owned by a CLO investor that really wasn't equipped to deal with it. And now I think it's a good news, bad news story. I think a lot of those investors at that part of the capital stack are equipped to deal with it. And so what that means is they're going to deal with it in a slightly different way. I think it's a more sophisticated way, but I think it makes it less likely that the existing owner is just going to be able to say, okay, well, we'll just extend and pretend through this. I think at some point people are going to have to sit down and do a deal where they share. And I think that in the end, I try to be a glasses half full kind of guy, especially on behalf of our hotel owners. I think we're going to end up in a rational place. But I think there's going to be more activity this time because I think that mezz lender and that owner are going to have to sit there and say, okay, how do we share this? Because, you know, at some point, and Neil, it'd be interesting to get your perspective on this. I think at some point, almost everybody's going to have to equitize. It's just going to come down to when and how much. And I think if I were an owner now, I'd be going as long as I can to avoid as much dilution as I can. But I think in the end, most of our owners that I talk to, and I'm dealing with, you know, we don't have many, but we have a few situations where we're involved as a guarantor or a lender or something like that. And I think it's just a different person on the other side of the table. And I would actually argue that that's in the end will be a good thing because I think that the public mortgage REITs and some of the private equity type capital that's been raised to target sort of a core plus return versus an opportunity fund return. I just think they're better equipped to deal with the situation. And I do think that that's going to create more activity in the end.
Yeah. Neil, if you have commentary on that?
Yeah, I would agree with that. I think, in some ways it will be similar, but it should be faster here this time around. But I think like the general playbook is for a lender today would be much like it was 8 to 10 years ago. It's like, hey, I want to lower the LTV of the loans I have on my books, and I want to increase the spread if I have to carry it longer. And I'll make up for that with new equity coming in the deal. And I think that can be an opportunity for some owners out there, or for some of the public companies, or for some of the private companies to step into that position, whether it be the entire asset or just taking a preferred equity piece, bringing in new equity to serve the lender and allow the lender to stay in there longer. And I do think like there's all the mortgage REITs and the credit funds, they are starting to take back assets. We are seeing that already. If a borrower is not willing to put any new equity into the equation, then we're starting to see that kind of move. We're probably, still a couple of months away from having lots of these opportunities. Mark is probably looking at a bunch. I'm sure that by the end of the year, there could be a lot of unintended owners, the credit funds taking the assets back and then looking for liquidity. I think they might have to hold it for a little while because I think the private equity community Kevin, you mentioned like this kind of core plus kind of buyer stepping in, and it's still a little early, until cash burn.
Yeah.
No, I agree. I don't think
Versus-
this is I don't think that that's a this summer or even this fall phenomenon. I'm just saying I think that's what, and who knows? What do I know? I'm just a CFO, but
No, but it's true. But it's
I don't know
next
what's
year.
gonna happen. In the end, I think it's going to take some time, but I do think that I do believe that part of the capital stack is much better equipped this time around to deal with it than it was last time around.
No, I think, look, I think that's inarguable. I think that's a great point. If you're on the ownership side, you've got CMBS debt as an example, you are trying as hard as you can to get forbearance. You'd like to get 3 months, 6 months, a year, as much as possible, covenant relief, the whole thing. But if you're on their side,
yeah,
you're charged with looking out for the bondholders, and in a way, you've got to be sympathetic with them no matter how tough they are.
Yeah,
right?
of course.
Like,
I just think there's more people in the fulcrum that aren't bondholders. I think there's more people in the fulcrum position now that are actually decision makers versus people that are just paid fiduciaries for bondholders. I guess we'll see.
Although I think what's going to be interesting, Neil makes a really good point about timing. And unlike past more conventional recessions, then it was a little easier to predict the timing because everybody had an economist model that they felt comfortable with.
Right.
There are no models for the pace and the steepness of this recovery. And so it's almost going to be by investor what their model looks like and when they think the optimal timing is to jump in. I think, but as a result, to Kevin's point, that's why I think for the industry, it's an advantage that you've got much more sophisticated players at the table.
Yeah, well, for God's sakes, let's not rely on models at this point. That's what got us here, right?
Well, there are certainly no models for this.
No, but here we were driving down the road, perfectly fine. Everybody in our well-kept cars, everything was going terrific. The government ran us off the road into the ditch. Then they're charging to pull us out of the ditch and calling us bad drivers. So, there's got to be some sympathy for how this came to pass. Are lenders not sharing in that sympathy at all, or are they just going to be bloodthirsty bankers as usual? Mark?
Bloodthirsty. I don't know. I don't know if I would describe them that way. I think they're pragmatists, right? And so everybody's got their job to do. Their job is to, one, not lose money. Number two is make money, right? And so I think they react to. So again, if there's no liquidity in the market, you extend. You're kind of more sympathetic, and you kind of motor along. With the amount of liquidity on the market, I think people are saying, no, I want some cash advances here. I want to see some real skin in the game.
Yeah, I think generally people are being rational. I mean, Mark, you see more than I do, but I think for our hotel owners that I talk to, I'll speak to our universe. I think it's a tale of two cities. I think it's if you have a bank loan, it's an easier conversation. If you have a CMBS loan, again, I think the fulcrum is in a position where someone you can have a conversation with, but you got to get there. And at the early stages of it, it's just that technology is just not designed for this. And I don't think it's anybody being bloodthirsty or doing anything they're not supposed to be doing. Look, the special servicers, I get like an email a week from buddies in the special servicing business, like, hey, when you're laying off people, can I, send them my way? Cause I got to staff up. No, it's just that they're not equipped for it. And so I don't think it's, right. I think everybody's being rational and doing the best they can. I don't think that you're always going to have capital that tries to take advantage of an opportunity to make money. That's what they're supposed to do. Right. But I think generally speaking, people are being pretty rational, at least what I'm seeing in our universe.
I think.
What will be interesting to watch, Michael, is exactly what Mark said. For the first 90 days, you did see that empathy. People said, I get it. Of course, forbearance for the next 90 days. But that's running out now. And to Mark's point, everybody's got to get back to their job. And their job is not to lose money and to make money. And so I think those discussions are going to be coming to a head relatively quickly, not out of a void of empathy, but out of an urgency to take action and do what they're paid to do.
Neil,
I think the other thing.
you've got a number of different kinds of assets in your portfolio. As you come out of this and you look to the future, is there a particular style of asset that you would concentrate on from an investment perspective going forward, or types you might decide to lighten up on?
You know, Mike, I think it's still like it's a little too soon to make a big kind of capital allocation strategy or decision for the coming years. But clearly we've felt what most in the industry have felt, that the drive-to regional resorts are recovering quickly. Select service hotels are easier to manage in a 20 to 30% occupancy environment, and you can actually get to break even sooner. So we feel good about those parts of our portfolio. We've never been that group oriented, but the group hotels that we have in our portfolio are struggling more so than others, and we're keeping them closed longer. But we get the question a lot, what about the cities and the urban markets? We've always been very focused on the gateway markets around the two coasts. And we do believe that it is going to be a slower recovery in those markets this cycle. But we haven't lost faith in the cities. It's too early to tell whether this is going to be a 2-3 year recovery for these cities like previous cycles, or whether it's going to take longer. But there are some, New York is a market that we've been very active in for 20 years or so. It's been a challenging market to be an owner in for the last 3 to 5 years, frankly, pre-COVID even. But the silver linings about New York are going to be that there will finally be hotel closures. There's been hotels that have been running unprofitably for years, and this may lead to actual, calling it obsolescence. The lodging industry used to have a obsolescence factor that just kind of went away, and things were always just kind of hanging on by a thread for different reasons. And so I think you'll see some significant supply reductions in the cities. I think you'll see some reduction in short-term rental inventory in urban markets. And I think that and then most of these urban markets have diversified their demand pretty significantly. Even a city like New York, which used to be all about financial services, today is really the biggest office tenants these days are Google and Facebook and some of the biotech industries on the east side. And so I think, we're not feeling like the cities are gone forever, but they will have a slower recovery. And so if we were choosing today to sell hotels, we're probably more likely to lighten the load in major urban markets because we think of it as being a little bit slower recovery. But again, that's going to be a function of what pricing is in the marketplace, because we do think that they will recover. It's just a matter of time. Last cycle, in coming out of 2000, 2001, it was scary to be a New York City oriented company. We were building hotels south of 14th Street. We were down near the World Trade Center. You couldn't even get to our sites for like a year and a half because the smell was so bad, because you just couldn't, there was police tape out there. By 2003, the lodging market in New York was hopping, real estate values were going up again. And so I think it takes some time. Last cycle, we saw New York City and a lot of the urban markets recover first. So from 2009 to 2011, you saw like the fastest recovery in the big urban markets. That led to a lot of new supply in those markets because that's where you could get construction loans from 2011 to 2013. And that made the cycle in these urban markets a little tougher this time around. I think it's possible this time that it's a slower recovery, but some of the benefits of that could be much less supply and actual deletions from supply from some of these cities.
Yeah,
that's our take.
Yeah. I'm involved with a portfolio that's limited service, select service, some extended stay, secondary and tertiary markets. And they went from the 20s, they've climbed back up to the 50s now. This past weekend, they were in the 60s, believe it or not. So, you know, maybe it pays to be away from the coast and in some cases. If you look at...
I think it would, Mike, I absolutely agree with that. And I think in the short term there will. I would just caution that, you know, it's that when the markets recover quicker, then that's kind of where the construction lending goes again. And some of those, the Sun Belts and the suburban markets have suffered less. But if you're a 3 to 5 year investor in lodging, I'm not sure if that should dictate your investment theory or thesis.
No, I agree, and I think they're also the easiest to build in. It's very, you know, simple to go to those places. But the bankers can be pretty scared for a while, I think. I think so. So I think that's probably a good thing. Tony, what is your pipeline in the U.S. just come to a screeching halt, or are people doing, you know, a lot of thinking about where they want to be next and being active in terms
Yeah,
of
it's certainly not coming to a screeching halt. We continue to approve a bunch of deals every month. You know, particularly on the select service side, they're not going to open for 24 to 30 months. And I think those developers are betting on opening into a much stronger market than we find ourselves in today. I think most of them also understandably believe that new wins, and they think there will be lots of deferred maintenance in existing product. And so they see themselves opening in the teeth of a recovery with a bunch of unrenovated competitors. So, you know, our pace is certainly not where it was the last number of years, but it's far from grinding to a halt. It is disproportionately select service, as you would expect. But we continue to see some full service activity, particularly on the conversion side.
Hey, Kevin, how about you guys?
Yeah, same. No different story. I think you have, if you're a well-capitalized, you know, developer and you have got a site that's entitled and ready to go, you're thinking about, hey, I might lose, you know, if I wait too long, I might lose this site to somebody else, right? And I'll bid, you know, look, if you're bidding a construction project now versus you were bidding it 6 to 9 months ago, you're feeling a lot better about where you're bidding it out. And yeah, you may pay a touch more for your financing, but in the grand scheme of things, that's not what matters, because as Tony said, well, you'll open into a recovery. So those are the folks that ultimately are going to do better. I think you're seeing more rational behavior, which is good. I think, you know, our volumes, like Tony's, are down, you know, pretty dramatically. We think, you know, our approval volumes will be down pretty dramatically this year. And I think that's good for everybody, right? In a recovery environment, you want really good projects that make sense to get done, and you don't want the marginal project to get done, right? And so we're trying to be, as we always are, very balanced about it in terms of making sure the projects are good, making sure they're not going to blow up existing owners. We try to make, you know, we spend a lot of time making sure that our brands don't, you know, try to not have our brands compete with each other and all that good stuff. And so I think, you know, I'd say it's far from grinding to a halt. I think we're seeing the same thing that Tony's saying.
Okay, thank you. Hey, Mark, how would you give us the terms of a deal that you're working on, or a conceptual deal that you're working on in the rescue capital? Is that preferred equity? Is it what form does that take? Is it convertible debt?
Yeah, I think it can take the form of preferred equity. I'll come back to that. It could take the form of mezzanine in some unique circumstances, but that's the exception, not the rule. It can take the form of a convertible note. And the key is, and it also depends if it's single asset or portfolio, right? So if it's portfolio, what you want to do is bring the capital in at a level above the assets, so that you don't have to go get permission from the lenders, right? And so you're not coming into the SPE, you're lending in some kind of corporate level or partnership level that's above the SPEs if you're trying to get the security of a portfolio. At a single asset level, you probably do have to go get the cooperation of the senior lender. But if you're bringing in new capital and improving the senior lender's loan, then they're going to be thrilled, right? So we're involved in a transaction right now where the senior lender is getting paid down about 5%.
Mark, stop trying to justify your fees. You can call it whatever you want to call it. It's preferred equity.
It's
right?
preferred equity.
Call it whatever you want to call it. It's preferred equity.
It is, but like
it looks like a duck and it walks like a duck and it quacks. It's a duck.
I suppose. And but it depends on how levered you are. So in other words, there's another portfolio where
head of the common and behind the debt. It's preferred equity.
Preferred equity. But in one of the convertible note deals, the owner will actually get half the assets. I mean, basically get half of the value of the asset. So the cost of the capital can range anywhere from low double digits into the 20s, depending on how levered the portfolio is, the quality of the portfolio, the locations. It all goes into the blender. But most common, to your point, KJ's point, is preferred equity. So.
Well, if it's convertible, you've just got to make the assumption from a compensation perspective that it will be converted because you'll get paid at a much higher rate than you would if it's just debt, right?
It never crossed my mind. That's
how about full service assets obviously are in very, very tough shape. How many assets do you have closed now? I'll ask this of, let me ask this of Tony. How many Marriotts are, big full service Marriotts are shuttered?
Yeah, so I don't have it broken down by brand in front of me, but I can tell you at the peak of the crisis of our 7,200 hotels around the world, we had just a shade under 2,000 closed. As of last Friday, we had 876 closed, and of those, about half are scheduled to reopen in the next 45 days.
And those would mostly be full service, I presume?
Yeah, I mean, the full service hotels are disproportionately higher percentage closed than the select service, particularly domestically.
Yeah. And Kevin, you get about the same percentages?
Yeah, no, well, I mean, yeah, I don't know about, our numbers are smaller just because we're a smaller, we're just a little company, unlike, but I think it was about 12 or 13% of our hotels that were closed at the peak, and now it's under 5%. And and of that, so it's about 300 hotels for us that are still have suspended operations, and that's a little bit less than 5% of the company. And of that, it's about 50 of those 300 we manage, which means they're more likely the bigger full service hotels.
And are those concentrated in certain markets?
Oh yeah, for sure. They're big, big urban locations in the Americas and in Europe. That's pretty
And
much.
it's, I mean, Mark, it's really following the virus around the world.
Yeah, for sure.
So at the outset, the whole China portfolio was shut down. Today, every one of our hotels in China is open, but Europe is meaningfully more closed down today.
Neil, how about you? How many did you have shut?
We've currently we have about 20% of our portfolio still shut. In 45 days, or by the end of this summer, we would expect about 10% of the hotels to be shut. And for us, those 10% would be full service or luxury hotels that have a significant group component to them. We've kept most of our select service hotels open throughout this period. And most of our lifestyle independent hotels are now all open as well. But it's the bigger box hotels that are still closed today, unless they happen to be in a drive-to resort market. Like one of our more successful hotels right now is the Marriott in Mystic, Connecticut. Drive-to traffic from New York and Boston. And so despite having completely underutilized ballrooms and things, you have a great place for people to vacation from that area. So it is very market by market specific. In the urban markets, we have kept most of our hotels open. A lot of our center city kind of urban markets are select service, so we've kept those open. The independence and lifestyle, we're just opening up right now when we feel like there is a little bit more transient business coming in. It's not a lot, but there's a handful of travelers coming on the leisure side, and the early bits of business transient you're starting to see. And so it's across this summer, it's been relatively gradual, but by the end of the summer, we should be almost fully open.
Have you done any personal traveling on business?
I have moved around a bit. We've been, we consider ourselves essential workers because we are housing so many essential workers around the country. So all of our offices have been open and operating. And we've been very careful, but moving around to our properties. We have some of our partners, or two of my partners are out on the West Coast right now at all of our hotels there. We've been covering Florida and the Northeast from here. It's actually quite nice to get out to some of your properties. It's great to see you read all the bad news, but there are employees that prefer to work. That are still feeling like this industry has a lot of mobility to it, and that they want to get back and start farming. And even behind masks and even behind shields and plexiglass, you can see and feel the hospitality in all of the employees' perspective as well as from the guests. They've adjusted very well to this new world of social distancing and engagement with your eyes rather than the smile.
Hey, Tony, how about you? You've been traveling?
A bit, mostly local, but I've been to New York a couple times, Boston, and it is a new reality. I have not flown since late February.
Okay,
but I've been on the train quite a bit.
Oh, train travel. Kevin?
I flew yesterday. I flew back from Nantucket yesterday. I was working from there for a couple weeks. I've not traveled for business, but we just authorized I probably shouldn't say this because then Tony's going to send his people out on the road, but I just authorized a few of our development people to travel to look at deals over the last couple weeks.
Yeah, well, that's good. Mark, I guess you're popping around as usual, or no?
I've made a couple trips. Yeah, I've made a couple trips. And what's interesting is on the deal front, we're doing a lot of virtual tours. So live tours as well as recorded. And that seems to kind of suffice in this environment for short term on the transaction front.
Do you think you will continue that virtual tour post COVID, or is that something that you will go back to in person?
I think we'll offer it just to generate early interest, but I think people will go back to travel. I'm convinced the new normal is normal. And once we get on the backside of either a vaccine or some kind of immunity, which we should have one or the other or both by a year from now. And my test case for that is if you Google up Times Square, January 1st, 1919, you'll see people packed in like sardines side by side. And, that was after the 1918 Spanish flu. 600,000 Americans died. And it was 10 million people today would be the equivalent. So people are communal. That's what makes us human beings. And so we will want to travel, be with people. And so I think that the new normal is normal. But it could take, several years to get back there, obviously.
What's your guess in terms of this recovery? Will it be U or V?
It's a broken V. We saw kind of a quick spring back already, better than people expected as far as the unemployment numbers and as far as GDP. But then it'll plateau for a while, and then you'll see kind of another upswing on the backside of the vaccine. So I would call it a broken V, modified L. You can come up with all kinds of things. But the bottom line is that you won't really be in a position, I don't think, to have full travel unimpeded until, next summer. And then there's a psychology to ramping up, and then there's how much destruction was there in the economy. But I don't think that Zoom is going to replace travel. I think it'll accelerate the need for it, but I don't think it'll replace it. And the consensus from all of our clientele is that we'll be back to 2019 NOI performance by 2023. So people are making their capital decisions fundamentally around that assumption. Some people think it could be a little bit earlier. Say 60% believe 2023, 15% believe 2022 sometime, and the balance are later than 23. If you think it's going to be you're more negative than it's going to be 2023, you're probably not a capital participant right now.
Yeah, I think the thing that people today in 2020 that are still afraid to get on an airplane because of 9/11, right, which is 20 years ago. So people have been so terrified by this virus and the catch-22 that you can have no symptoms and have it and be a carrier, is an added, a little terrifying, zombie-ish aspect to this whole thing. So, people jumping back on airplanes as quickly as they did after 9/11, which wasn't all that quick, I predict it's going to be kind of slow.
Yeah, I think that's why it's 23 versus 22, So, but the good news is with the contact tracing, there hasn't been that many incidences tied back to the airlines. The filtration systems are pretty strong, what have you. That said, if you're elderly, you got pretty existing conditions, you're unlikely to jump on an airplane until we're well past the vaccine or immunity.
Yep. I see Jeff down here.
And just on that point, I guess I think it is going to be a slow recovery for sure for domestic travel, for flights, but there is the advantage of it's also going to be very hard for U.S. travelers to travel to Europe or to the Caribbean or to Mexico or to other areas. And so just capturing the U.S. traveler, the domestic traveler here in America, insourcing travel demand is something. And I think it makes it less scary than if
Hey, listen, right now your passport is useless.
That's right.
You can't take it anywhere. I mean, you can go to the Caribbean, but virtually you can't go anywhere else. You can go to Canada and have a meeting, no problem. You just have to stay in a hotel for 14 days before you go to your meeting. So
that's right.
That's a good thing.
Michael,
Staying in a hotel for 14 days is a good thing.
Yeah.
Michael, on that note, I think we need to wrap up as it's
Okay.
It's the witching hour now to finalize. So I want to thank you. Excellent conversation. Thank you for leading that, and to everyone else, Neil and Kevin and Tony and Mark. Greatly appreciate your time, your insights, and look forward to being able to chat with you again in person sooner than later. So
yeah.
thank you all for being here.
Thank you very much, Jeff.
Thanks, guys.
Thank you.
Appreciate it. Cheers.
Thank you, guys.
Stay well.
See you soon.
Okay, as usual, IREFAC does not disappoint. Very insightful commentary. We heard about urban properties, borrowers needing to put in some equity to avoid losing their assets. No ideal models. Everyone has their own as we're trying to figure this out. New wins against unrenovated competitors. So some of the things are still intact as they were in pre-COVID. So here we are. We're gonna wrap it up here. If you could advance the slide. As our next two ALIS Summer Update virtual events, Thursday, 3 p.m. Central Daylight Time. A program originally scheduled for the Nashville, for Margaritaville, Nashville. So that'll be this Thursday. And then next Monday at 1:30 p.m. Central Time, that will be in the program that was scheduled for Dallas will be on. To register, just visit alissummer.com and you'll be able to get all of that information. And then let's hit the next slide. And don't forget ALIS Law coming up in January. ALISconference.com and ALISlaw.com is where you can find more information. Sponsorships are currently available, and registration will open in early August. So if everything goes right, we'll see you in LA in January. And I think yes, there is one more slide. We have great news in that all of the hotels that we were originally scheduled to have ALIS summer updates at this summer have come on board for next summer. So if you really want to see the TWA hotel, mark July 12th, 2021. If you really want to see the new Margaritaville Nashville, mark July 15th. Virgin, the new Virgin Hotel in Dallas, July 19th. And of course, a very old friend to the ALIS conference, the Century Plaza, now the Fairmont Century Plaza with massive renovations. We're looking forward to revisiting that old friend next summer as well. So that's that. And I think that is a wrap for this edition of ALIS Summer Update, the New York edition. I want to thank everybody for being part of this this program, and we look forward to seeing you on Thursday and next Monday, and hopefully in person sooner than later. Thank you very much.